Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant, with me, my colleagues Nigel and Reema. Guys, good morning.
Hi, good morning. First, wishing everyone a happy Makar Sankranti, Pongal. Yesterday, we forgot wishing about Lori, but, spring is here.
Yeah, absolutely. Prashant, wishing you as well, family, the festivities.
Festivities, yeah.
And I made up for it, Reema, because on Chartbusters, I remembered. I didn't want my home ministry to get into trouble at home. So Lori was yesterday, and I managed to do it on air at 10:30 a.m. But today, we're remembering it right on top.
Right, Makar Sankranti and Pongal. So hopefully, spring is here. It shows up in the markets. New beginnings, yeah.
Absolutely. Let's hope so. And we had some movement last evening, right? Late last evening, which I think bodes well, at least incrementally, in terms of directionally where things may be headed. I just want to start with, of course, the top kind of sort of market information which you need to know as we begin this session. So first up, right, you have this call between the India External Affairs Minister, S. Jaishankar, and U.S. Secretary of State, Marco Rubio, who held a phone call. We got to know about this later at about 9:30, 10 o'clock or so. So this is late into the night. Both discussed, what we understand is trade negotiations were talked about, defense, energy, and nuclear cooperation. A major focus was also on securing supply chains for critical minerals. I'm talking about the phone call between both leaders. And, from S. Jaishankar later sort of, put out on social media saying, well, it was a positive phone call. Sergio Gore, the U.S. ambassador to India, essentially said that it was pretty constructive as well. So both sides acknowledging and, of course, promising to stay in touch as well. So this is important. And as I said, it doesn't, of course, mark a thaw in terms of these troubled relationship that India and US have had, but it's a step in the positive direction that at least, leaders, not lower level bureaucracy, but top leaders are talking and once again. And I think you've got to give credit where it's due. It's, of course, Sergio Gore being in India, stationed in India with, of course, direct access to President Trump. Now, I just want to, the other thing, of course, which is going to be market moving, perhaps market moving. This was supposed to happen last Friday, but did not. And it could happen tonight, which is the Supreme Court of the US may give a ruling on Trump's IEEPA-based tariffs, the tariffs which were imposed under emergency powers. It's not a guarantee that we will see a ruling, like it was not a guarantee last Friday. But, the chatter is, the reportage is that we could see it today, later today. And this is important, right? Just 2 days back, President Trump came out on social media saying that, well, if these tariffs are revoked, it's going to be disastrous, it's going to be a mess, we'll have to refund hundreds of billions of dollars. Think about it. For India, which is facing 25% reciprocal tariffs and 25% penal tariffs, if the Supreme Court says, well, these tariffs are illegal, it's completely a different picture as you come back. Now, I've said this before, that most likely this administration, tariffs is a central policy for this administration, and they will find a way to reimpose these because it's also real money. $150 billion a year is not trivial. So they need the revenues, and they'll find other ways to do it. But it's lengthier, and perhaps it's, the end result will be at least lower rates of tariffs than where we are right now. Because, those sections require investigations, etc. So it's an important event. Tomorrow, of course, is a market holiday. So if the Supreme Court rules and some of these tariffs are partially struck back, you won't be able to react to it tomorrow. You'll only be able to react to it day after. So it's almost like a repeat of Friday when, you would have gone into a weekend and come back to some of this stuff on Monday. So more later as we go along. Price action-wise, not very much. US equities were weaker. S&P down about 0.2. NASDAQ down slightly as well. You had JP Morgan earnings, which caused financials to be lower. Visa, MasterCard were down 4. JP Morgan saying that Trump's threat of 10% interest rate cap would could significantly change its business. We'll have Wells Fargo, which will report, Goldman Sachs, Morgan, etc., which will report through the course of this week now. Oil prices perked up 2.5%. We're back above 65. So, I mean, the initial assessment that, more Iranian supply, more Venezuelan supply, beg your pardon, will mean lower oil prices. It's not really been turning out that way. Trump, of course, also encouraging Iranians to protest, keep protesting, and said that, and I quote, help is on its way. I'm not sure if it's a 25% help there is help in other ways as well, but it's an important situation to track. I'll just leave you with levels. We once again, on both the Nifty, and it's dramatically different, right? The Nifty is at a long-term average, which is a 20-weekly average. We broke below it intraday, and we managed to close above it once again yesterday. That level now is 25,644. For the Nifty Bank, we are treading water around the very short-term 20-day moving average, but we managed to close above it there as well. 59,419 is where we stand. I mean, sentiment is still iffy, fragile, uncertain, and I think some of those things will not go away in a jiffy, in a hurry. But, I mean, I think looking ahead later today, if that ruling comes from the court striking down some of these tariffs, I think it will provide optimism, a little bit of leverage. And of course, I mean, the negotiating table will look slightly more different as far as India-US is concerned. 30 points lower on the GIFT Nifty is the indicative open. Nigel has walked across to the wall with the F&O positioning and what to watch out for. Nigel, over to you.
Well, Prashant, we moved from one weekly expiry to another. The Nifty weekly expiry played out yesterday, and today is the sensex expiry, which has been pulled forward because of the holiday that's been declared tomorrow. The Nifty, remember, we have been bouncing off the lows, but it's still pretty much on a sticky wicket. It needs to conquer some of those higher levels, and then, in fact, we'll get some confidence coming back. Yesterday, what stood out was the FI flows. Well, the net sell number was lower than what we've seen in the previous few trading sessions. And Nimesh had mentioned towards the end of trade yesterday that there was some basket buying that was expected. And that could be one of the reasons that, in fact, the FI net sell number, that's been hovering around 3,000, 3,500 crores. That came down a little bit. You'll want to see more of the same because the cash market selling has been quite intense over the last few trading sessions. And in the futures space, it appeared there was some bout of short covering that took place, particularly on the Nifty Bank, because the Nifty Bank was the outperformer yesterday, and you had the open interest that was lower in trade. But it wasn't from the FIs, because the FIs, they went back to their shorting base on the index. They added close to 4,000 contracts on the short side. On stock futures as well, they went ahead and added close to 33,000 contracts on the short side. The stock futures could be an arbitrage as well that they're playing out there. But in short, they went ahead and they added short positions. And that's why the net short positioning continues to remain very, very aggressive at around the 92% odd mark. So whether it's a domestic queue, whether it's a global queue, if there is a bout of, there is some positive trigger that comes in, then we could see a big bout of short covering that will play out. For the time being, we're in search of that positive trigger with the FIs aggressively net short. The PCR, well, that had moved from around 0.62 all the way to around 0.9. That's cooled off back to around 0.79 because yesterday we saw the 25,800 call. There was a big open interest built up out there. Aggressive writing is what we saw. While on the downside, since you're seeing action at around the 25,500 put, well, you'll bet on this 25,450 to around 25,500 level holding out. And incidentally, that's where the recent low was. So on the 12th of January, we went ahead and we hit that mark of around 25,473, which is the important mark on the downside. Resistance comes in at around 26,000 odd because of the, options data, as well as the 20 DMA. The Nifty Bank, that will have to play a bigger role and will have to do the heavy lifting because it's protected. The 20 as well as the 50 DMA in that vicinity. You don't want this mark of around 59,000 odd to break on the Nifty Bank. The other big one is Reliance Industries. It's corrected a little bit from the top. Remember, it comes out with its set of numbers. Maybe, in fact, the street could sniff some kind of, optimism getting into the numbers because of the way the stock has corrected. And it's still, at a very, very crucial juncture is what we're seeing on Reliance Industries. It's below the 20 and the 50 DMA, but the 200 DMA, well, it's holding above that. So we'll keep an eye out on that one as well.
Thank you very much for that. Well, yesterday's price action, it was heartening to see that the intraday high and the intraday low was higher than what it was on 12th of January. So yesterday, the intraday high on the Nifty was 25,899. The low was 25,603, which, as Nigel pointed out, is higher than the low that we had on 12th of January. So 25,473 is the level to watch on the way down. But lots of geopolitical headlines to contend with. And on the macro front, we also got the US December CPI numbers, which went up 2.7% on a year-on-year basis, same as November. The core CPI, which excludes the volatile food and energy, went up 2.6%, the lowest since early 2021. William Lee, Chief Economist, Managing Director at Global Economic Advisors, is now joining in on the show. William, thank you very much for joining in. Since the last time we spoke, the Fed independence once again has been challenged. There is far more uncertainty surrounding Iran in the mix. We're still awaiting the Supreme Court decision on US tariffs under IPA. So what is your read on macros, at least for the near term?
Isn't it great that the world never changes in terms of the shocks that affect the investment agendas for most people? And I think we start this year, 2026, no differently. With all of these shocks that you've just mentioned, let me start with the whole issue of Fed independence. I think that's becoming a really red herring. Chair Powell, I think, has been a bit petulant in his response to his accusations that he's criminally liable for some of the cost overruns. I think the truth of it is that Chair Powell was the administrative governor at the Federal Reserve before he became chair, and he was responsible for the start of the renovations. But I think the overall vulnerability of the Fed to political criticism is not so much about monetary policy. It's about the senior management's allowing mission creep to quadruple the Fed's operating expenses over the last 20 years. That quadrupling is faster than the growth of federal outlays, faster than the growth of CPI. And I think the fact that the Fed has overextended itself has made itself vulnerable to a lot of critiques and a lot of potshots. And this whole cost overrun is but the focal point of those kind of political sniping. But I think in terms of the issues that I think investors are caring about, the tariff situation, I think, remains in somewhat uncertainty in terms of the basis for the tariffs. But it's without a question that the tariffs will remain because tariff revenues have become such an important part of containing the federal deficit. They're not going to lose almost $2 trillion over 10 years of revenues. So I think for investors, I think we should continue to believe that the world will continue to be a tariff-ridden world where investment incentives are put in place to let people get around the high tariffs.
William, good morning. I think you're the only person we've spoken to who said that the attack on the Fed is because of the renovation expenses. Come on.
Well,
you really believe that? Or are you just saying it?
The reason why you asked me on the show, I believe, is that I give you a different perspective. I'm not so naive to believe that it's not correlated with the fact that Trump really hates Powell and wants to get rid of him.
No, but why? Why? Because of interest rates, right? I mean, there's no. It's nothing else.
I think as far as Trump's concerned, the interest rates that really matter are the long-term rates because that's what affects mortgages, and that's influenced more by global.
No, I'm not saying it's right or wrong. I'm not saying it's right or wrong. I'm just saying that let's identify the right reason behind why. I mean, there is it's happening in the way it is happening. But in terms of again, as I say, it is what it is. If it blows up more. Will it hurt markets? I mean, what's your opinion? You think no? I mean, markets have pretty much looked through everything so far.
Markets, have a historical perspective in the sense that every president has really made that mandate very clear. I want lower rates. And again, I want to remind you, in 1965, President Johnson invited William McChesney Martin to his ranch and shoved him against the wall and said, "My boys are dying in Vietnam, and you won't let me have any money? What's wrong with you?" Right? I mean, that's pretty rough. And as much as the name calling is pretty vociferous by President Trump, that's nowhere near slamming McChesney Martin against the wall and saying, "You won't let me have the money to save these boys in Vietnam?" No, that's a very different world. So I think markets are used to having presidents want lower rates. And I think the fact that the Fed is independent is an act of Congress and will remain so. And I think all this hype about losing independence is a lot of clickbait. Draws a lot of headlines, but I think the truth of the matter is that the markets, as you see from the reactions of the markets today after the Powell petulant response, it goes on.
Hi, William. Good to see you, Ben. William, the last time we chatted, briefly spoken about how dependent the United States is on Venezuela oil. And, they have an eye out there. That was a month or so ago. And early 2026, Mr. Trump has made his move. Do you think the markets in general are underestimating that big geopolitical risk? Because Mr. Trump is on the go, with regard to Iran, Venezuela, other regions as well. Do you think there's a bit of an underestimation? And possibly there could be a big geopolitical risk. Yeah, go ahead.
I can honestly say your viewers heard it here first, right? I was the first, I think, to remind everybody that almost half of U.S. refineries are geared toward the heavy, high sulfur content crude oil that comes out of Venezuela and the Canadian tar sands. So the U.S. Really is operating optimally when it gets more than half its imports of the heavy crude stuff. And Venezuela was the main source of that for the longest time. But I don't think the U.S. went into Venezuela just to ensure its supply of heavy crude. I think the reasons given, the drug issues and related issues, I think are the ones that dominate. But it doesn't hurt that the U.S. can really use the heavy crude, and more importantly, to take it away from the refineries in China that also are geared toward refining the heavy crude. And most of these refineries in China, by the way, are the independents, the pop-up refineries. And I think those are the geopolitical tensions that are in place to try to get the U.S. to essentially reinvoke the Monroe Doctrine, the Roosevelt Corollary, and now the Trump Corollary, which is to say, get out of our backyard. This is our playground.
William, that example, it's that image you put in my head. Carter bagging. Who's the Fed president? The Vietnam War. The example you gave. Who were the two gentlemen? There was President Carter and.
No. It was Lyndon Johnson. And William McChesney Martin was the chair at the time. And let me give you a difference in terms of Lyndon Johnson is slightly bigger than Trump. He's 6'4", about 250 pounds. Martin was about 5'9" and about 185. So there was a big contrast in the two bodies. And when you have one towering over the other and shoving you against the wall. I hate to say that was the cause of, in fact, I don't say it's the cause of, but after Martin raised interest rates and prior to that incident, he didn't raise interest rates again until Johnson announced his retirement.
That's an interesting anecdote, and we'll dig in and quite an image you put in our heads early in the morning. William, thank you very much for joining us. It's always a pleasure. And good speaking with you, and talk to you again soon. You're absolutely right. I mean, we want different and varied opinion, and you bring that. You bring exactly that. So appreciate it. Thank you. Okay, well, I think what we're going to do is run you through the interactions which are lined up here over the next 2.5 hours or so. 9 o'clock, we'll have Dayanand Mittal of JM Financial Securities. He puts a spotlight on the oil and gas sector. 9:20, we have Arvind Maheshwari of BofA Securities, a market master of the day. 9:40, management of Keystone Realty on the company's third quarter business update. ICICI Lombard will be speaking with us at 9:50, post reporting the third quarter numbers. And towards the end of the program, Bank of Maharashtra joins us to break down their third quarter earnings. Stay tuned.
Well, time to slip into a quick break. We've got a lot of stock-specific action track for you on the other side. We'll get into that in just a bit, but I run you through the top 10 list for now. Tata Elxsi, Just Style, ICICI Prudential, 5paisa Capital, NLC India, Ola Electric, Endurance Tech, as well as Kidlocker Ferris. All of them will be reacting to positive news flow, while you'll have ICICI Lombard as well as Realtel that will be reacting to negative news flow. Take that break, come back, we'll get into all these stocks.
Welcome back. You're watching Bazaar Morning Call. Today is also an expiry and tomorrow is a holiday, and we're in the midst of a busy earnings season. Of course, a lot of the big stock action is going to take place on Thursday to Saturday. Today we've got Infosys. On Friday, we've got Reliance Industries, Wipro, Tech Mahindra, all post-market hours. And then on Saturday, HDFC Bank and ICICI Bank. But let's kickstart today's top stocks to watch with our entire research team standing by bright and early. This is CNBC-TV18's list of top stocks for the day. But first up, let me take it away with Tata Elxsi. Now, the key headline here is that the top-line growth has come in ahead of expectations, but the bottom line has been hit on account of the new labor code. The company's revenue growth has come in at 3.2%, sequentially better than estimates. Margins have expanded by more than 200 basis points to 25 basis points quarter on quarter, but the profits are down 30% quarter on quarter on account of an exceptional loss of 95 crore taken by the company on the back of the new labor code. The company also held a conference call yesterday where they did indicate that there could be more margin upside from here on. Automotive continues to be the big driver, but healthcare appears to have bottomed out. Now, remember last week on the back of the JP Morgan upgrade, Tata Elxsi had a fantastic session. Stock is still up 10% on a year-to-date basis, but the bears on Tata Elxsi still question the valuations because stock is still trading at 40 times plus forward multiple. So that's Tata Elxsi. But the other big one is ICICI Lombard. Yash, how did the numbers look?
Well, the numbers for the third quarter for ICICI Lombard look pretty weak. The top line, though, looks decent. The net earned premium, that has managed to grow at about 13% on a year-on-year basis. So that's been taken care of. But what's gone wrong is with respect to the operational performance. Your underwriting loss, that has increased significantly by about 1.3 times, coming in at about a loss of 354 crore rupees against about 152 crore rupees. Operating profit, that has dropped by about 17%, coming in at about 571 crore rupees of profit. Because of which, what has happened? The PAT has dropped by about 9% at about 659 crore rupees. Combined ratio, that has significantly increased to about 104.5 as compared to about 108%. Now, what has happened is with respect to motor insurance, that is the space, that is the sector where major part of the losses have come from. Underwriting losses in the motor insurance space, that has increased by about 1.37 times at about 408 crore rupees.
Okay, all right. Thanks a lot for that. Yash, Shubhal, Rima, coming back to you. You're also tracking Just Dial.
Well, steady sort of a number. Top line growth is flattish on a quarter-on-quarter basis. On a year-on-year basis, it's about 6.5%. The key positive is the expansion in margins. So the company continues to rationalize the operating expenses, which has boosted the company's profits. If you look at the headcount, it's actually declined on a quarter-on-quarter basis. So 31.2% margins and expansion versus 28.7%. But analysts are questioning that without having feet on the ground and getting more SMEs on board, it will be hard for growth to pick up. But yes, in the current quarter, there is a margin expansion. Again, an exceptional loss on account of the labor code dents the bottom line. For Just Dial, it stands at 21 crore rupees, which is why profits are down 1.2% quarter-on-quarter and about 10% lower on a year-on-year basis.
Okay, all right, Rima, thanks for that. Going back to Yash. Yash, you're tracking ICICI Prudential as well?
Well, that's correct. The numbers came yesterday during market hours. The numbers operationally looked strong. The value which the company was able to derive looked strong. The brokerages have sounded positive today, but there are certain important aspects from the con call also which will impact the stock today. The company said that APE growth in the first 9 months of FY26 was slow, and this largely happened because it was working on a large base. Also, the company said that they've delivered a 2-year APE CAGR of about 13.8%, which is marginally ahead of industry CAGR of about 13.3%. Especially in terms of looking ahead, they see improving trends for APE in Q3. Retail protection remains a structural opportunity for them. Remember, this will be important if margins have to be protected and grown from here. Other than that, the company said that corporate protection is in single digits, impacted by a slowdown in MFI-linked credit business, which happened in the first 9 months of FY26. As far as early signs of recovery in group protection is concerned in Q3, and persistency ratios remain below the desired levels. So, of course, as far as APE growth, clear focus coming from the management on growing APE going forward, so far which has happened because of the large base it was working on.
All right, Yash, thank you very much for that. Well, we're going to also talk about 5paisa and Railtel, which are in focus. Upasana has got details. Upasana, morning.
Good morning. First up, let me start with 5 Paisa Capital. On a Y-on-Y basis, number look weak, but there's a good recovery sequentially aided by strong uptick in companies' average daily turnover. Now, if we talk about the growth in the average daily turnover, it has seen an uptick of as high as 24% sequentially, and companies' client funding book has also seen an uptick of 4% sequentially. Coming to the main numbers now, that the revenue has seen an uptick of nearly about 2.8% sequentially. EBITDA margin stood at 24% with an uptick of 405 basis point, and net profit has also seen an uptick of nearly about 30% sequentially. Now, coming to RailTel, the stock will be in focus today as the orders from Bihar Education Project Council worth over 600 crore have been cancelled due to unavoidable reasons, is what the company has indicated. Now, if you look at the order details, the order were 257 and 262 crores is mainly for the procurement and installation of smart classrooms at government schools in Bihar. And the third order, that is worth 90 crore, is mainly for the supply of teaching learning material from various classes. So cancellation of this scale can impact companies' near-term revenue projection and even the financial performance. So we'll be keeping an eye out on that as well.
Upasana, not done just yet. More stocks which you're tracking today?
Yes, certainly, Reema. Now, firstly, let me start with NLC India. It has signed an MOU with the government of Gujarat to invest nearly about 25,000 crore in Gujarat. This is mainly for the development of large-scale renewable projects, which include solar, wind, BESS hybrid projects. Next up is Ola Electric. It launches time-limited discounts on few models, which is on mainly 4,680 Bharat Cell-powered portfolio of the company. Endurance Tech also in focus as Maharashtra government has increased the incentive from 606 crore to 858 crore for the company. And the admissible incentive under the scheme for the remaining period now, that is from 1st of April to 30th September 231, shall be up to 128 crores. Now, lastly, coming to Kirloskar Ferris, the activities at Jejuri plant in Maharashtra have resumed 13th of July, 13th of Jan onwards, and the plant's operation were temporarily suspended since 26th of December, which has now been resumed. So all in all, we'll be keeping a track of all these stocks in today's trading session.
Okay, all right. Thanks very much for that. And we'll, of course, quickly recap the stocks on our list today. So, Tata Elxsi, Just Dial, ICICI Proof, 5 Paisa Capital, NLC India, Ola Electric, Endurance Tech, and Kirloskar Ferris are stocks on the positive side. Stocks with negative news flow are ICICI Lombard and RailTel. Okay, commodities in focus. What's top of mind? Manisha is here with a roundup of all the commodity action. Manisha, good morning.
Morning, and thank you for that, Prashant. Well, all-time highs yet again. For silver, we are just inches away from $90 an ounce, and after gaining 150% in the previous year, we are up by nearly 26% in this year itself. Well, China restricting export of physical silver and then strong inflow of speculative money within commodities really seems to be supporting. Not just silver, take a look at gold, and we are trading at all-time highs into this one as well. After making 53 all-time highs in 2025, gold has made 6 all-time highs already in 2026. It also has strong gains for the metal prices. Copper is trading at all-time highs. Aluminum and tin trading at 3-year highs. Even crude oil prices are trading at near 3-month highs. So strong support continuing across commodities today as well.
Thank you very much for that, Manisha. We will slip into a very short break on that note. On the other side, we'll get you excerpts from our exclusive conversation that we had with market veterans at the CNBC-TV18 Market Forum.
Welcome back. We've got, 30 minutes to go for the pre-open session to kick off. And, GIFT Nifty, I think, is still indicating 30, 35 odd point lower start. The CNBC-TV18 Market Forum took place yesterday evening, and we had a bunch of interesting conversations, snippets of which we will show you through the course of the day. Now, one particular interaction was between, let me just tell you quickly in a second what the idea behind this was. The idea essentially was Financials are the go-to place according to most in 2026 and beyond. Valuations are reasonable. So we got two people together, investor and a company, and this company has done phenomenally well for this investor. I'm talking about Ramdev Agarwal, Motilal Oswal Limited, and their investment in AU Small Finance Bank. It's been, I mean, for the earliest investment, it's been 100-bagger for them, and they, of course, still continue to hold shares in AU Bank. So just a slice of that conversation. The idea was to ask Ramdev, why did he back AU, and what are the qualities he looks for when he looks at financial companies? Take a listen.
We had set up this first private equity firm, private equity company, and we had about 400-500 crores to invest to 10-12 companies. So one of the thought process for me was value migration from public sector to private sector. So I said, and that time HDFC Bank had already become somewhat. So we said, I told Vishal, why don't we look at some budding private sector lending companies? So get me few small ones, because we were giving 30-40 crores, so we couldn't have got big one. So we're looking for this thing, but profitable. Okay, so in 1 week's time, they bring in front of me Sanjay. Okay, now Sanjay, I said, I think they're making about 2 or 3 crores profit. Yeah. 2 crores, yeah. So I said, so how much, what exactly you do? Yeah. So they said they're onward lender of HDFC. So we had great respect for HDFC. So he said they have got 200 crore line from them. Yeah. I said, we'll check with them whether you actually got 200 crores or not. Yes. If Aditya Puri has given 200 crores, we'll definitely give you 20 crores. That was the total due diligence.
Ramdev, you also shared his views on how to spot a great bank early and why he felt that AU Bank had what most others could not manage eventually. Listen.
I was very clear that there will be many more HDFCs will be born. And a lot of guys that tried to be next HDFC. And nobody kind of made it. In fact, the most successful possible bank right from ground up is going to be AU. And I had been, so see, one of the things he said, I will never give unsecured loan in India. That was one of the promise of yours.
Yes.
So they're never proud. See, a lot of companies, banks, they suffered because of this unsecured loan, the MFI part of their own book. So fortunately, they were not heavily into this right from beginning. So they had a very good risk management. And when I visited their office in 2008, I found their office to be run tighter than my office. And I was always proud of my office. So I said, ye bande to bahut sahi hain.
Tighter means?
Tighter means you could see, at 11 o'clock, people are silently sitting. You just feel, whether
it's a well-run operation.
Well-run operations or not. Or it's a loose, aisa kuch nahi. It was small operation. And yet it was very professional, very disciplined. I mean, those are things you judge because I'm visiting companies from 1985. So I have seen hundreds of companies, badly run, very well run, world class. I've seen all of them. I mean, like I've seen Infosys from 95 onwards. I mean, so those things help you understand whether there is something better than special, because you're just talking about 50-60 crore worth of company. Total market cap to be about 70 crores.
Right.
So these other things, when you look at a company, what is the option value you are paying for all this? You're getting a terrific entrepreneur, terrific future. The runway is very large because this country is going to have 14 to 15% credit growth compounded for next 100 years. In that, you are starting with literally nothing, I mean, some 100, 200 crores. So runway is massive. Size of opportunity is very large. Business is reasonably good. It's not like Nestle or Lever, but 18, 20%, 16, 18%. So it's a damn good. But you can deploy a lot of capital. You can deploy 5 lakh crores, 10 lakh crores. But there needs to be a discipline. So most important thing is, how do you handle capital? How do you, when lend, how do you get it back? It is not an easy trade. I cannot do it what he can do. Because when we invest in equities, we know it can go to zero. And we allow it to go to zero, and many times it goes to zero. But these guys, they cannot afford to do that. When they lend, they want everything back. थोड़ा सा पठानी कार्यक्रम भी हो. So
इतना खराब भी नहीं है सर.
नहीं इतना खराब भी नहीं, but being good lender needs to be very tough. Even if you see Aditya Puri, he's not a very soft guy. He's a, you got to be strong. Even physically, you got to be strong. And he was.
Well, I think that is the inimitable Ramdev Agarwal in his own style, right? I mean, explaining some of the reasons why he backed AU Bank. Now, AU Bank's managing director and CEO founder, Sanjay Agarwal, of course, was also right there on stage, as you saw. And he makes a bold call. He believes AU's bank does not want to be the next HDFC bank. It wants to be bigger. Listen in.
Let's be honest here, right? HDFC Bank never had an advantage of AI. I think they never had an advantage of their own, they didn't have any role model, right? I have this HDFC Bank in my front, right?
Right.
I have more technology. I have more ambitious people with me. I have more bigger economy, right? So my aim cannot be only HDFC Bank, to be honest. In my next 25 years, it can be bigger than that also. I think the challenge is not opportunity. The challenge is how mentally you are solid enough to take that scale. Or to remain in that corridor that you will get right. So I think my belief is that in next 15-20 years, I know that I'll not be there, but this institution will become big, and you will all people be really proud of what we have created in the last 20-30 years. So
that's a round of applause for Sanjay. I think that's a phenomenally well put.
Yes.
Story and, of course, ambition.
And you were talking about sir, AI, sir? Yeah. Because, some subjects maybe not be going deep. But at bank level, Prashant, I am seeing that, because for the scale, HDFC would have done much hard work. Now hard work can be replaced by AI. You will need people, right? But you can't put energy. You can't put them that they have to do everyday hard work to build a next HDFC Bank, right? In my opinion, we will create on a 50% effort bigger bank than HDFC Bank in next 25 years because of the tech support.
Which is now available, which was not there back then.
Yes, you can't even imagine what kind of AI is doing in that sense of making the life easy. The language has become, no matter what. As of now, if I want to build a South franchise, I need to understand 4 languages. Now I don't have to understand any language because AI is talking to the customer, right? So where that capability was 25 years back.
Yeah.
So when I'm deep in Tamil Nadu, I have a support of AI-led communication, right? So I think these small things are really helping me as a CEO to think bigger, scalable, and that too in control.
Yeah.
It is not that, when we are building up, there are many gaps will come in, right? So I think, in my opinion, the technology will actually fast forward the entire scale building mindset.
Ramdev Agarwal, and that's a very interesting of course, portion from Sanjay Agarwal and his vision to become bigger than HDFC Bank and why it's possible with 50% of effort, as he puts it. Now, just to wrap up this, Ramdev also shared his view on what to look for in terms of where the next AU will be. He believes it doesn't necessarily have to be on the lending side. There's enough and more on the financial side which is opened up. Listen in.
Actually, opportunity is not only among the lenders, but now the much bigger opportunity is opened up in the non-lenders. That is the capital market. Whether it is AMC, whether it is wealth management, they're just about started. So, fortunately, they are not lending type. Here you need a platform where there is no capital adequacy so far. And with 10,000, with 1,000 crore capital, you can manage maybe 10 lakh crores or 20 lakh crores. So what is required is to create a competent team and competent distribution to manage assets, because the wealth generation in the country, just to give you some numbers, in last 20 years, the total savings is about $12-13 trillion in India. If you add up all 20 years. Next 20 years will be, hold your breath, it will be more like $50 trillion. Just the savings. Mark to market on top will be another. So we're talking about $100 trillion flowing in here. We don't need anybody's money now. There is enough money from the domestic savings coming into the capital market. Now that capital needs to be managed by wealth managers, asset managers, intermediaries, all sorts of things. Now, can we find one emerging platform, whether it is a wealth management, whether it is asset management, and hundreds of them will come. But can you find a Sanjay Agarwal in that vehicle and maybe seed, So
You don't have to look for a Sanjay Agarwal in a bank. You can look for...
no, bank to I'm already invested.
Bank to hai.
Yeah.
So,
Now he will set up insurance, AMC, wealth management, everything he's going to do it.
Well, let's slip into a very short break. Up next, we will focus on the volume buzzers on Dalal Street, and we'll also connect with Sudarshan Sukhani and Mitesh Thakkar for a few technical trading ideas.
Welcome back. You're tuned in to Bazaar Morning Call and hope you're having a good morning. Well, it's that part of the show when Horvaz joins us to tell us about all the big movers in trade yesterday and some of them that were backed by delivery. Harmas, take it away.
Morning, Nigel. And the big talking point, other than what transpired in yesterday's trading session, was the rise in oil prices. And the rise in oil prices has had an effect on both ONGC and Oil India as well. Both of them were up in yesterday's session. In fact, both of them now have been gaining for the last 3 sessions. Oil India is up almost 9% in these last 3 trades, while ONGC has gained more than 5.5% as well. You take a look at the volumes. ONGC yesterday had over 2 crore shares that were traded, the 20-day average being around 84-85 lakh shares. And even in terms of Oil India, more than 1.2 crore shares were traded yesterday, significantly higher than its 20-day average, which is just around 16 lakh shares. And even delivery for ONGC, out of those 2.2 crore shares that were traded, 1.2 crore shares were marked for delivery. And for Oil India as well, 50% of the 1.2 crore shares that were traded, or close to 61 lakh shares, were marked for delivery. Needless to say, both of them were significantly higher than their 20-day average as well in terms of delivery volumes. The one stock that has been seeing consistent selling pressure over the last few days has been Dixon Technologies, and it was the 3rd straight day of losses, among the top losers on the Nifty 500 yesterday, ending at the lows of the day with losses of over 5%, and has now declined in 6 out of the 9 trading sessions that we have had so far in this new year. Now, yesterday's session, we had over 12 lakh shares that were traded. The 20-day average is close to 7 lakh shares, and there was delivery-based selling worth over 450 crore that took place in Dixon Technologies yesterday. Out of those 12.5 lakh shares, 4 lakh shares were marked for delivery. That too was double the 20-day average of around 2.5 lakh shares. In the last 3 months itself, the stock has declined from levels of well over 17,000, now down to levels of 11,000, and it was now, yesterday's close was the lowest level since June of 2024 for Dixon Technologies. And lastly, a news flow driven name possibly could be in focus today as well, Larsen & Toubro, among the top losers on the Nifty yesterday. 4th straight day of losses, is down over 6.5-7% now in the last 4 trading sessions. Volumes on Tuesday were the highest in 3 months, where 50 lakh shares were traded yesterday, the 20-day average being just around 13 lakh shares, so almost 4x its 20-day average. And there was delivery selling worth over 850 crore that took place in L&T yesterday. Out of those 50 lakh shares, 22.5 lakh shares were marked for delivery, the 20-day average of 7.5 lakh shares, and yesterday's closing price took the stock down to its lowest level in the last 2 months.
Okay, all right. Thanks a lot for that, Hormuz. Well, moving on then, India's External Affairs Minister held a phone conversation with US Secretary of State Marco Rubio, focusing on cooperation areas of trade, critical minerals, nuclear energy, as well as defense. Parikshit joins us to give us a quick update on that front. Morning, Parikshit.
Well, this call was initiated by the Indian government just hours after Donald Trump announced that U.S. would be imposing a 25% tariff on countries doing business with Iran. While we don't know whether Iran was discussed, but this conversation is extremely important because this was the first high-level contact between India and U.S. in the new year. Secretary Rubio congratulated India on the passage of the nuclear energy bill. U.S. has expressed interest in investing in India's nuclear energy sector and also for increasing civil nuclear cooperation. He also said that this will open up opportunities for American businesses. There was a discussion on the bilateral trade negotiations which have been going on. India had, in a way, closed negotiations in December, saying that we've offered the best possible deal, and now it's up to the president to sign it. It remains to be seen whether we will be able to conclude a deal in the next few months. There were also regional developments which were discussed, and it's possible that the situation in Iran may have come up for discussion as well. And there was a discussion on Indo-Pacific. The new U.S. ambassador to India, Sergio Gore, has termed these developments as positive. He also said that Marco Rubio and Subramaniam Jaishankar are likely to meet next month. So let's hope there is a breakthrough soon. But why this is important is because India would be seeking clarity from the U.S. on 2 or 3 fronts, whether this 25% tariff would come into effect retrospectively, also because of our trade with Iran that has been going on till now, or is it going to come up in future? Number 2, whether it will be over and above the 50% tariff that is already there on India. And thirdly, whether our waiver for Iran and Chabahar port continues or not. So India would be seeking clarity on all those fronts. And we would be wanting to make sure that this 25% tariff does not come on India at a time when we're negotiating a trade deal.
Thank you very much for that. That is a big event trigger to watch for the markets. But back to the trading action. Sudarshan Sukhani and Mitesh Thakkar now join in. Gentlemen, good morning and thank you very much for joining us this Wednesday morning. So Sudarshan, let me start with you. Yesterday you were saying the Nifty is in a bit of a no-trade zone. What happens today? What is the call that you're taking? Because we have another expiry.
Yeah, good morning. Well, there is an opportunity for the Nifty trade today, and that is to go long if the Nifty dips towards 25,600. That's a condition. We want to buy only on a sharp dip. If we see a dip towards 25,600, then consider buying the Nifty, at least for the day, with a tight stop just below 25,600, approximately at 25,550. So we give a very small stop and take a chance, assuming that this dip could be bought by others also. So yes, there is a buying opportunity on a sharp dip today.
Okay, got that, Sudarshan. Let's get in Mitesh as well into the conversation. Good morning, gentlemen. Mitesh, what's your approach? The good news is that in the last couple of days, at least there's an attempt to bounce off the lows. However, it still appears the Nifty is on a bit of a sticky wicket. Your take?
Good morning. To me, I think the structure and the setup is not on the positive side. But now the key test is whether we can hold on to important support zones. And to me, they are around 25,400, 25,320. That's where a couple of weekly averages and the 50-day average, I think, combines. But yeah, that's the important level. That's also the low where we had a, bottom on the 7th of November when the closing was 25,492 and intraday low was around 25,318. So we might test those levels, but if we can hold them, then I think, we'll be all good, and then I think we might look at rebounds. On the contrary, getting past 26,020 levels on the upside will signal, that the negative trend, which is negative structure, which is in place, will be negated. But as of now, I'm not sure which will happen, but the odds to me look like more towards testing of 25,400 first. So slightly negative in the next couple of weeks, but day-to-day basis, of course, trading will be slightly different.
Got that. What about individual stock ideas? Mitesh, you go first.
Yeah. On the individual stock side, I have a buy on Tata Elxsi with a stop at 57.49 for targets of 5,900. A conditional buy on Colgate. It's been a stock which has reversed in the last 2 days when the markets have been slightly negative. So if it starts getting past 21.19, 21.20, buy with a stop at 2098 for targets of 21.65. Similarly, if IDFC First Bank breaks below 82, it will be some kind of a negative breakdown. So sell then with a stop at 83.70 for targets of 78.5. And Bosch has come down to a support area. So buy with a stop below 37,300 for targets of 39,000.
Thank you very much for that. On Tata Elxsi, JP Morgan says that the margin expansion was impressive, 240 basis points on a quarter-on-quarter basis, and they've gone up to margins above 20% after 3 quarters. And the company targets to get back to 25% margins by the end of FY27. So back to historical levels in terms of margins and a lot more margin expansion from current levels. But the only thing is premium valuation, because the stock trades at 43, 44 times at a premium to other companies like KPIT Tech and Tata Tech. But let's get in some more trading ideas. Sudarshan, what are you going with?
Well, I'm going with a slightly long bias. IndusInd Bank is a buy with a stop under 685, 895 Syngene is a buying opportunity with a stop under 620. Overall Reality is a buy with a stop under 1625. And my only intraday short or a short is National Aluminium, the stop above 365. For all the buying ideas, we must wait for the markets to stabilize.
All right. I think we must wait for that stabilization to take place because things still at the margin a little fragile. Thanks very much. We'll talk again, Sudarshan and Mitesh, for that. We'll come back after a quick commercial break here, and we will be nearing the pre-open, which is about 7 minutes away. Dayanand Mittal of JM Financial Institutional Securities puts a spotlight on the oil and gas sector ahead of the third quarter number. Sonal is also going to be here to set it up for us. Stay tuned, coming up.
Welcome back. This is Open Exchange. We are coming to you live from the CNBC-TV18 Motilal Wall studio. Well, in a few minutes from now, we'll get the pre-open rates. But let's turn our attention to our special segment, Quarter Se Quarter Tak, where you get your expectations from each sector. Today, Sonal turns the spotlight on the oil and gas space. Sonal, over to you.
Thank you so much for that. Well, this time around, the oil and gas space is expected to report a mixed quarter. Remember, Singapore gross refining margins, they rose sharply by about 97% on a quarter-on-quarter basis in quarter three to around $7.50 per barrel. At the same time, Brent crude prices declined by about $5.4 per barrel on a quarter-on-quarter basis, averaged at around $63.6 per barrel. Let's start with the big boy Reliance Industries. The oil to chemicals business that is expected to report strong growth led by higher refining margins. Overall, EBITDA for the company is expected to rise by around 5% on a quarter-on-quarter basis. The retail segment is likely to see growth of around 4% on a YY basis, while oil to chemicals business will see strong growth of 15%. Reliance Jio is expected to post revenue growth of around 4% on a YY basis. Let's switch to the oil marketing companies now. Standalone EBITDA for HPCL, BPCL and IOCL, all three companies, is expected to increase in the range of around 9 to 18% on a sequential basis, expecting strong refining margins this time, and the receipt of LPG compensation is something which will aid earnings for the companies. Upstream companies, they're expected to see a weaker quarter. Oil and gas volumes for both ONGC and Oil India are likely to largely remain flat both on a quarter-on-quarter and on a YOY basis. However, realizations are expected to decline by around 7 to 8% considering the crude oil price fall. EBITDA for both the companies as a result could also fall by 7 to 8% on a YOY basis. Let's talk about city gas distribution companies. They are expected to report strong earnings, supported by healthy volumes and margins. So Mahanagar Gas is expected to see volume growth of around 12 to 14%, the highest in the sector. IGL around 5%, while Gujarat Gas could see a volume decline of around 8%. Let's now talk about gas utilities. They're expected to deliver moderate performance. Petronet LNG is likely to see flat EBITDA growth, while growth for GAIL and GSPL is expected to be lower. Let's end this with valuations based on FY27 earnings. Reliance trades at around 27.2 times, BPCL at 10.1. We have IOC HPCL between 7.8 to 10.7. Among city gas players, Indraprastha Gas trades at around 15.9 times. It has come off from its highs. Mahanagar Gas at 11.3 times, and Gujarat Gas continues to be the most expensive in the CGD space. But you know, a lot has changed since quarter three. In fact, in last 10 days, we've seen so much happening in terms of global macros, supply, etc. So the most important part in these results will be the management commentary.
Indeed. Thank you very much for that. We also have with us Dayanand Mittal, Oil and Gas, Telecom and Oil and Gas Research Analyst at JM Financial, now joining in. Thank you very much for joining in. You know, as Sonal said, right, the backward-looking data is there, but as we look ahead, we've seen a surge in crude oil prices now with $65 per barrel for Brent. So the street will watch for the commentary and what lies ahead. So lay out the picture for us in terms of expectation and what we could hear from the management.
Yeah, good morning. So yes, obviously, you know, crude price has been highly volatile last few years, and we saw sense of that last few weeks also with all those talks about this 500% tariff, possible US attacks on Iran, hopefully not, but yeah, in case, because Iran is a big supplier of crude, almost 3.5% of global production. So any disruption there would be would be very sensitive for Indian companies' earnings. So obviously, management would have very limited visibility to comment much on that. So it will be more dependent on what US president decides and various other geopolitical factors would be key. So I doubt management will say, but yeah, uncertainty in earnings for OMCs and ONGC Oil India will continue. As we know, lower oil price is good for OMC's earnings, OMC's marketing business earnings, while a higher oil price is good for ONGC Oil India's earnings. So yeah, probably the volatility in the sector will continue, I guess.
So going in for Q3, which are the pockets that you like where we could see an earnings surprise? There is a bit of a risk, a mismatch between what the companies might deliver and consensus expectations?
So given in oil and gas sector, most of the variables are known ahead of the earnings. So not much surprises per se. So in 3Q, OMCs will report very strong earnings. So that strong earning momentum for OMCs will continue. Key event for them would be, in terms of future earning outlook, would be whether a government let them make this high marketing margin with the earning right now, or there could be an excise duty hike ahead of budget. In terms of other companies, it would be largely a soft quarter. ONGC Oil India, given $4 to $5 QOQ decline in crude, it will be a soft quarter. Gas companies, given LNG prices have been high, though it has moderated off late. But from a 3Q earning perspective, volume will be soft, even for gas companies, some recovery, but not major. In gas companies, the key event would be when spot LNG price moderate, which we believe is more like a second half CY26 story with a lot of LNG supply capacity coming in. I think that should aid their earnings over the next 6 to 12 months.
Okay, hi Dayanand, good to see you. Nigel on this side. As you said, maybe these OMCs, the street is already preempting very good numbers for Q3. Yeah. At current juncture, what is your preference between the oil producers as well as some of these oil marketing companies? Because crude oil prices, some on the street believe that maybe it's forming a bit of a basing out process, and from here we'll actually see crude oil prices move up. In that sort of a scenario, would you be leaning now towards producers, or you stick with the OMCs?
So our preference has always been towards ONGC Oil India versus OMCs, primarily because OMCs are on aggressive capex spree on refining and petrochemical, where we think it's a value destructive process from a minority shareholders' perspective. This project tends to be a single-digit ROC in refining because of the terminal value concerns, and petchem because of the intense competition from China. So OMCs and also OMCs valuations have been above historical averages. Off late, the correction has meant that now they are in a fair value zone, but we don't see much upside here. And given this excise duty hike risk, I think better to stay away from that name till the clarity emerges. ONGC Oil India is what we like. Particularly, Oil India is a top pick in the oil space. We think it's a 15% earning compounding story over the next 2 to 3 years because of the strong output growth in the oil and gas business, and also NRL, which is a refining subsidiary, that is expanding the capacity from 3 million ton to 9 million tons. So that would also, because that refinery has got a huge tax incentive benefit, so that could be a strong contributor to Oil India's earnings over the next 2-3 years.
On oil marketing companies, you were saying the question is going ahead, will they be allowed to enjoy the high refining margins, or will we see an excise duty hike in the budget which caps it? What's your own expectation?
So our retail petrol diesel price breaks even at about $70-71 Brent. So $70-71 Brent, OMCs make a normalized marketing margin. So when crude was $60 few days back, they were making almost like 6 to 7 rupee per liter higher marketing margin. But now crude is at jumped to 65. So the extra margin that they're making is in the range of 3 odd rupees per liter. So government is in a tricky position. The call would be a function of where do we see crude price stabilizing. So yeah, a few weeks back, we thought excise duty hike is almost a done deal, given they're making 6 to 7 rupee higher, plus government revenue was under a bit of pressure. But now with crude having moved up, I think government might be in two minds. So difficult to say. Yeah, so it's a tricky call. That's the nature of the industry we are in.
Dayanand, I'm not sure whether you track MRPL and CPCL. Those stocks, they burst up, and then in fact now they've cooled off yet again. We know the refining margins actually have been holding pretty strong, and globally as well, there's a bit of a shortfall in refining capacity. So we understand, post Russia-Ukraine war. Any view with regard to refining margins, as well as if you have a view on either of these names, do you think they still have more headroom to move up?
So yeah, so we don't officially cover, so I'll not comment on those two companies. But yeah, the reasons those companies moved up because diesel cracks went up from average of $15 to almost like $25 to $30 since last 2-3 months. This was because of talks about sanctions, US and EU sanctions on Russian oil, which led to some temporary disruption in diesel supply. But with the ongoing progress in Russia-Ukraine deal, those concerns have abated. Plus, winter, which is a seasonally strong period for heating oil demand, winter this time in Western Hemisphere has been moderate. It has been largely a warm winter. So the heating oil demand has also been a bit soft, and hence diesel cracks have moderated back to $16-17, and that's the reason the stocks have corrected back. In terms of refining margin, yes. So long-term refining margin, there are a lot of concerns because of EV-related impact on oil demand. Maybe 5 years, 10 years down the line, difficult to say. But long-term terminal value concerns in refining business stays. But in the near term, impact of EV on oil demand has been more on the lower side than what was anticipated. While the refining capacity addition from private players have been very limited because of those EV-related concerns. So capacity addition is falling short of even the modest oil demand growth, and that's what is supporting GRM. So we think in the near term, GRM may remain healthy, around $6-7 for Singapore GRMs. For OMC is around $7 to $8. So it should be healthy for next 2-3 years. Long term is where we are a bit worried.
Dayanand, Reliance Industries, that's down 8% since the start of the year. What is your own read of the fall? And when you speak to investors, how are they taking the decline in the stock price? What are the key concerns that they flagged off?
I think the biggest reason for the weakness seems to be doubts over sustainability of kind of 12-15% EBITDA growth in the retail business. Given last few quarters, it has been one quarter has been strong, another quarter has been weak. So no clear trends there. Management broad guidance seems to be retail EBITDA growth could be in the range of 15%. In AGM, management has been guiding for around 20%. Maybe because of this, their foray into quick commerce, where revenue growth is all right, but as we all know, quick commerce as of now doesn't make money, doesn't make EBITDA, and hence the EBITDA growth is where there's a lot of uncertainty and concerns in the near term. I think, but in the medium to long term, I think they should be able to deliver 15% EBITDA growth, given they're taking a lot of steps to recorrect the challenges which they're facing. I think that's the key reason which is dragging the stock. Telecom businesses, they're doing absolutely fine, so no concerns there. Oil and gas is like petchem is weak, continues to be weak. Refining is strong as we discussed, so largely neutral from a Reliance perspective. O2C is largely neutral-ish from Reliance perspective.
No, absolutely. And I just want to quickly look at the pre-open session and where it is finally left off. 80 points lower. So this is a sharp cut, and the pre-opens come to a close. 260 points lower is where the sensex has settled. Let's just look at Reliance, and of course towards the end yesterday it came up a little bit. It's down about 0.5% or so. So back to not at yesterday's low, but weaker. So I mean, 80 points lower. It's generally been a tough kind of a market. Opens have been lower, rallies have been fewer, rare. Yesterday, of course, we got one, but we still ended down and out. Maybe just quickly put up the stocks which we highlighted at the end, from the beginning, top 10, etc. If we have those stock stacks, just want to make a quick mention of it before we go any further. And some of this will come up. ICICI Pru, Tata Elxsi is down about 1.6%. ICICI Lombard is down about 0.25%. ICICI Pru is starting about 0.5% lower. The other names, the metal names, etc. Hindustan Zinc is there at the bottom of the screen. What a start Silver has had after a stupendous 2025. 5 paisa is there. Maybe look at Hindustan Copper as well. That's the other one which we want to highlight. The big movers, Just Dial, etc. The other big mover from yesterday was Dixon, and we'll have Upasana join us in a bit to explain perhaps what's worrying the market. But stocks down is up about 0.25%, so it's actually from highs of 20,000 at about 11,260 or so is where that one is trading at. Dayanand, we'll leave it there. Good conversation. Thank you for your perspective. Appreciate your time here on CNBC-TV18. And then we're running it to market open. So let's get the 9-10 calls out of the way. Sudarshan and Mitesh are with us. Sudarshan, what do you have?
It's Syngene. Buy Syngene with a stop under 620.
Mitesh, what about you?
I'll go with the. Sorry, just a minute. I think I've lost my page. I'll go with the sell on IDFC Bank if it breaks 82.
Okay. Syngene and IDFC Bank. Mitesh, it's a buy or a sell, IDFC?
IDFC is a sell. If it breaks the levels of 82, then I would suggest taking short positions.
I see. Okay, got that. Thank you very much for that. You know, I was talking about metals earlier. Let's just put the spotlight on Vedanta, where I think Nuvama is weighing in, and you know they're calling Vedanta their top pick. Najal, take it away.
Well, that's right. You know, Nuvama has been spot on with regard to Vedanta, and now they've gone ahead and they've upped the target price. So they mentioned that Vedanta is their top pick. The target price now moves to around 806. Remember, earlier it was around 686. They're making a few interesting points. At current CMP, they say that, in fact, you know, the current price doesn't even fully factor aluminium and zinc. So they believe all the other businesses are available virtually free. They've gone ahead and tweaked their estimates. They're increasing their FY27 EBITDA estimate by close to around 17%, FY28 by around 8%. The key reason is they're factoring in higher commodity prices. They believe that commodity prices are likely to stay high in comparison to historical averages. And because of this, the EBITDA will compound at close to around 20% growth for the next 3 years between FY25 to FY28. So Nuvama has been positive on Vedanta. They're going ahead and they're upping the target price and are quite optimistic on prospects even from here on. Well, L&T was the big stock on the losing end yesterday. Vivek was updating us all through the day yesterday. Now we have brokerages as well that have written. Vivek, good morning. Run us through the flow and what brokerages are making of it.
Well, that's right. So L&T yesterday was the top nifty laggard. We told you about how almost 8.7 billion worth of orders in Kuwait was up for cancellation, and they were considering re-tendering on the back of the fact that the L1 bid itself about what Kuwait authority was actually anticipating and taking into account in terms of the cost. Now, L&T yesterday gave an update to the exchanges saying that the projects referred to in the report were not part of the order book. Just a clarification, in the Q2 con call, L&T had said that the Kuwait orders, they were L1 in 3 out of the 5 orders, totaling up to $4.5 billion. So the orders were not part of the order book, but L&T was L1. So probably in Q3 or in the upcoming quarters, once they receive the LOA, they would have gone ahead and it would have reflected in the order book. A couple of brokerages have reacted to this particular material development. JM Financial says potential delay or cancellation of these bids may adversely impact order inflows. They expect L&T to meet the 10% order inflow guidance for FY26, but from FY26 to FY28, they have cut core order inflow estimates by 5 to 6%. Axis Capital says that this particular event signals a scale down in win-worthy order prospect of close to $4.5 billion. What they also say is that oil prices that stay below $60 per barrel could slow hydrocarbon infra urban development capex in the Middle East. And lastly, UBS says that they see downside risk to the consensus order inflow estimate of close to 22% that the street was anticipating.
Okay, I think we've got 30 seconds to go for a start. Vivek, thank you very much for that. Purvankar, our third quarter update is at the bottom of the screen. And collections are up 22. Real estate, right? I mean, has been such a hot talking point after its underperformance in 25. But of course, I mean, that underperformance in 25 was after a huge outperformance, in 24, 23, etc. So we've got the first rates, which will start to come up in just a bit. And we will look at indices, look at a quick snapshot view of the Nifty, and then we'll look at individual names. Nifty Bank okay, first rates are starting. It's down about 1/3%, so in line with where the pre-open left us with. 59,400 in the Nifty Bank, a third lower on the mid-cap, about 0.2 lower on the small-cap index. Sensex is down 1/3%. The Nifty is down about 1/3% as well. I mean, so it's a sideways lower start once again. For all indices up there. 70 points is what that translates, that 1/4% cut translates into for the Nifty. Look at the Nifty heat map and we will take it from there. So what do we have? Bulk of everything is down, right? I mean, at least to begin with. it's an interesting day because tomorrow is a market holiday. There is the possibility of a tariff ruling later today. But, you know, once bitten, twice shy, right? I mean, Friday we were in a similar kind of a position and then, of course, nothing happened. And Monday you had that big downtick. ONGC, Infosys, Coal India, etc. on the upside. On the downside, Aisha, Ultratech and Max Healthcare, which are the top losers. 60 points. So it's kind of tentative. It's not a washout, but it's a tough open. Rima.
Well, we've given up between yesterday and today. We've given up all of Monday's, rally that we had. So now week to date, we're absolutely flat. The Nifty's opened around the 25,690 mark. The level to watch will be at least yesterday's intraday low of 25,600, and prior to that, it was a low of below 25,500, 473. So that would be some markers. What's dragging us? Aisha Motors. I think there is a downgrade which has come through on Aisha Motors. So that is the top Nifty loser. You've got cuts coming through in Dr. Reddy's. The surge in crude prices is putting pressure on Asian Paints, HPCL, also weak in trade. TCS has lost 0.5%. In fact, oil marketing companies are weak in trade. HPCL, BPCL on the back foot today. In terms of IT, TCS, Wipro, Tech Mahindra weak in trade. Infosys ahead of numbers is seeing some buying, but again, no big gains, just up close to about 1/3 of a percentage point. On the way up, strength visible in ONGC, a beneficiary of the rise in crude prices. So ONGC is doing well. Coal India, NTPC, so PSUs actually on the front foot. For IT, it's a mixed bag because not just Infosys, even HCL Tech is holding up in the grain. But all in all, it's a sort of a muted, lackluster kind of a trading start. No big fall to begin trade with. The advanced decline ratio also pretty much split right down the middle.
Well, that's right, Rima. A couple of stocks deserve attention. Polycab, there's a large trade that Nimish is alerting us about. So will be interesting to see who exactly were party to that transaction. As of now, we're putting close to around 0.5%. I think Nimish believes it's a little higher than that. So we'll try to get you clarity on that front. That stock is a little bit lower. Puravankara, I think I saw that quarterly update flash for our viewers on the screen. That looked pretty good and explains why Puravankara actually is bursting away up close to around 7.5%. Vedanta, Novama likes it, the bulls like it as well. The stock is up 1.5%. Remember, the stock has seen a big surge, but that continues its winning ways. And giving it company on the upside is Hindustan Copper as well as Hindustan Zinc. Now, one observation of the last few days is suddenly, some of these stocks are not ending at the high point of the day. They're actually coming off intraday. For the time being, Vedanta, Hindustan Zinc, Hindustan Copper, all of them open up with a good amount of green. Tourism, finance, as well, that's one of the stocks that's actually trading on rather large volumes in today's trading session. So I think that one should come up for you on the screen. Net, number of stocks advancing and declining. A pattern in the middle, close to around 1,200 stocks apiece. The headline index is down. But the bulls, they'll be optimistic that with yesterday's low as a stop loss, we can see a bit of a recovery in today's trading session. For the time being, we're down 40 points out.
And it's, almost a clean split between winners and losers, 1:1 on the NSE. Almost down to the last stock, right? Let's just look at a few other names, right? So silver ETFs once again. Oh boy, I mean, I think it's just, it's become regular that, some of the top traded quotes, volume-led quotes on the NSE regularly now are silver E's. So silver B's 5%. And we should put this up at the bottom of the screen. The Tata Silver ETF, you've got HDFC Silver, SBI Silver. Across the board, it's all these silver ETFs doing phenomenally well. There, 4-5%. Just amazing. And this is after the phenomenal 150-160% rally that we've had in underlying silver prices last year. So it's a very, very strong start. What else, right? I think Vedanta, Nigel was highlighting earlier, it's up 1.7. The third top volume-led gainer. Hindustan Copper is up 1.7. So it's all, hard assets, commodities, base metals, and of course, precious metals as well. Keynes is up 1.25%. NetWeb is coming up with about a 1.25% gain. HEG, Interag, Builders, etc. You go down the list, but volumes start to fade away quickly. And that's where we are at. Rima?
Just Tata Elxsi, once again, that's down close to about 2%. Numbers are fine. The company's revenue has gone up by 3.2%. Margins have expanded. The company is talking about margins further expanding. But the problem for Tata Elxsi is the valuation. Valuations is close to 43 times forward multiple. And it's at a premium to companies like a KPIT Tech and even the others, Tata Tech. So valuations is capping the upside. Numbers per se are fine. And plus, as I said last week, the stock had an outsized rally. So maybe some profits are being booked on Tata Elxsi.
Tata Elxsi, by the way, is the #1 volume-led loser, by the way, Rima. So it's not on small volumes. I just want to highlight Hitachi, right? Power, it's down another 1% and had a bit of a bounce, but generally it's come off sharply from about almost 20,000 rupee levels a week ago. It's down to about under 17,000, 16,900 or so is where Hitachi is now trading at. So that's the other one. Federal Bank is down about 1.25%. Kalyan Jewellers is starting about 2% lower. L&T Finance is down about 1 1/3. So lots of stuff. Balaji Amines had a burst of energy recently. It's down about 2%. There is Kiri Industries. Yesterday was a big positive day after the collapse from the highs. Post-deal, it's down about 1.5% as well right now. So 20 points lower, tentative, 25,700 is where we're at. Arvind Maheshwari is head of India equities at BofA Securities. Great to have you with us here, Arvind. Good morning. And since this is the first time we're speaking this year, happy 2026. I wish this is a better one. Arvind.
And wish you the same. Happy to be here.
Thanks very much. The only question, and I want to start with that, is how important is this thaw in relations between India and the US, and will we see something? What are you hearing from your colleagues in Washington and elsewhere on how, actually in Washington, about how this is going to proceed? What are expectations like? I mean, what can you tell us, Arvind?
Well, at this point is anybody's guess, but we obviously we heard the US ambassador who's just taken on his post talk about progress on the talks. So that is definitely a relief. We call it disagreement between friends, and hopefully we'll find a resolution to this sooner rather than later. And in terms of what it means for the markets, obviously it's a big sentiment boost as and when the trade deal gets done. But ultimately, macro matters more. For any sustainable gains, we have to deliver growth. We have to see earnings come through. And ultimately, I think if we have to create long-term returns, that's where you will get the maximum sustainability, while this can create a temporary relief for the markets in terms of sentiment.
Arvind, so, and what's the view on earnings in that sense? Will third quarter deliver? We had Ramdeo Agrawal at our event yesterday who said, well, according to him, 350 companies that they track, the expectation is for a 20% growth. And he thinks that the fourth quarter, Jan to March, perhaps will be even better. I mean, of course, this is all in the realm of expectations. We'll see what the final delivery is. But what is your sense? Are you seeing first signs of a bit of a turn? Or not really?
Yeah, surely. I think after a couple of years of pedestrian mid-single-digit earnings growth, we think earnings this year is poised for a rebound. We should see about a 14% earnings growth this year, and which is how we are sanguine about the markets delivering a 12% return, mostly led by earnings. We think in terms of valuations at 21.5 times, we are already one standard deviation above historical average. So valuation-led upside is limited, but we think earnings growth is what is going to drive Nifty returns this year.
12% Nifty return, no valuation re-rating, but driven by earnings recovery. Arvind, hi, morning. This is Rima here. When you speak to foreign investors, are they willing to now bet on India after the kind of underperformance? And there is a possibility of a 12% return. As you articulated, there are earnings triggers on the horizon. Or they're still not convinced. And if we do get a trade deal, will that be the trigger that pulls FI flows back into India? Or even that won't be good enough because it's only a sentiment change?
So for foreign investors, obviously, it's a global playground and a zero-sum game. Currently, I think we are seeing them continuing with their 2025 P&L generators. So you saw the tech theme, which is the AI, machine learning, semiconductors, all of that play out extremely well in 2025, and that story sort of continues right now. And markets that offer exposure, we are seeing that play out in Korea, in Taiwan, in Japan, in the Asian hemisphere. So you are seeing that that chase continue, and India, unfortunately, in the listed space at least, does not offer as much exposure. So the underperformance that happened in 2025 and sort of the foreign investment getting attracted to those markets, I think that will continue to happen for some time. That being said, I think the case for further underperformance for India is getting diminished with once earnings start to deliver. You're right that we should start to see some of this outflow pause or ease. Also, at the same time, we are expecting Fed to cut rates, weaker US dollar. That typically, in the if you look at historical examples, is typically an environment where we see emerging market rotation, money coming back into emerging markets, including India. So we should benefit from of that. So our base case this year is for foreign, while we don't expect a surge, we do expect the outflows to stop and, in fact, possibly see a marginal inflow this year.
Okay, all right. Hi, Arvind. Good to hear. So some marginal inflows will be good. And as you're mentioning, India in the near term could continue to relatively underperform. Hope I got that correct.
Yes, that's right.
All right. Arvind, the other big talking point is what more is in store for the Indian economy? Because you have the RBI, they have gone ahead and they have cut rates multiple times. From the central bank side, there has been GST rationalization and various other measures that have been taken. So we're a little lower on ammunition maybe than a few months ago. What more can maybe be done on the fisc or on the monetary front to pep up this economy? Because as of now, still things are softish.
Yeah, correct. I would agree. And I think some of this takes time to make its way through into the economy, into corporate earnings, et cetera, et cetera. So we got also the, once in a decade government pay hike, which should boost consumption this year. So all of this that you mentioned and maybe some more reforms that the government has in store. We have the upcoming budget on 1st of Feb and we'll see. But we think that there is definitely more that will come from the government side, because it's very clear they are trying to push the growth agenda. And as these measures make its way into the economy and into the corporate bottom lines and earnings inflect, we should see investors starting to come back as bottom lines offer some support. The one area I think we do like is the earnings where the earnings visibility is higher and valuations leave room for upside. So which is the financials and the rate sensitive cyclicals, and which is something that we continue to push for. Premium consumption is another area. I think some of these areas you will create alpha on. I don't think we get a broadening of earnings immediately. That's probably a more FY27 story. But you will see pockets of alpha generation available for investors in this market even in the next 6 to 12 months.
Arvind, I mean, just to take a cue from another conversation with the AU Bank's promoter yesterday, right? I mean, I think you mentioned AI, etc., briefly, and there's not too much representation here in that sense. But there is one line of thinking which is that when it was about building out physical infra for AI, a lot of money has gone into it, and now slowly that'll move away into adopters in the US and elsewhere. In India, of course, financials is seen as a big. I mean, anyone with large, sets of data, right? Organized data which can be leveraged using AI and other technologies. So AU essentially told us that with AI, with 50% less effort, they can scale, twice as fast. Is that it's not talked about that much at this point in time. Do you think that it'll become a bit of a boost, or it's going to be slow burn, slowly? I mean, this will start to show up across the financial space, banks and lenders mainly, to begin with.
Yeah, no, look, I think this is definitely becoming more topical and is part of conversations even globally, not just in India, is the practical use cases and who is really benefiting from all this AI spend. Currently, we are only focused on how much is being spent on AI infrastructure and creating that infrastructure. But ultimately, we will have to see where rubber hits the road in terms of who really is benefiting, where is value being created in the chain, and those are the guys who will benefit from it. So as this dust settles down, and it'll take a while, but I think it's still early days to find out. But there is already, we have talked about this for global banks, including obviously the Indian banks as well. Anybody, you're right, that there is an element of cost savings and growth push that can come with lesser resources as we start to get more and more use cases on AI. So there's definitely the case, but I don't think it is going to happen in 3-6 months. It's going to probably take longer before it starts to make a meaningful impact on bottom line.
But maybe if you like financials, because it's one of the few sectors where valuations are still reasonable. This is one more reason to.
Correct.
Or at least it's not a factor working against it, right? How much it will help, maybe
absolutely.
A little bit longer.
Oh, absolutely. Yeah. Absolutely.
Got that. Arvind, great conversation. Thank you very much, and come back more often for these chats. Thank you. Okay, well, Dixon is what we're going to focus on next. Dixon was down about 5-6% yesterday. Phillip Capital has put out a note attributing some reasons for why the market's a little anxious about Dixon. Upasana has gone through that note. Upasana, take it away.
Well, concerns regarding the declining volumes from Motorola continue to cloud on the stock. Now, Phillip Capital has given a sell rating on this with a target price of 9,085 per share. It says that the volumes from Motorola, which is Dixon's largest client, has seen a decline of 20% on a year-on-year basis in Q3 FY26. Now, Dixon has the significant client dependence on Motorola since 45% of its total revenue of FY25 comes from this single client, Motorola. Over the last couple of quarters, Motorola's volume have seen a sharp decline, which is why we saw the stock declining constantly since some time. And even remember that the Vivo JV approval is also pending, is what is concerning the investors. Now, for Q3 FY26, Dixon's volumes have been down due to key reasons that has been highlighted by the brokerage. It says that the Motorola has been facing strong competition from Apple, which has resulted in muted sales in Q3. And also the greater issue is the increased outsourcing to Carbon. Now, Motorola has outsourced nearly 23% of its volume to Carbon in Q3 FY26. Now, increased competition will result in declining volumes even further for Dixon from FY27 is what the brokerage believes. Hence, we can clearly see the sell rating on the stock.
Upasana, thank you very much for that. Well, what we're going to do is turn our focus back on that event that we held yesterday in Mumbai, the CNBC-TV18 Market Forum. And we had veterans across the fund management universe, people like Ramdev Agarwal, Manish Chukani, CIOs of top companies, top economists at our event. We will play out some of this stuff for you now and through the course of the day. So here is a bit from a veteran investor, Manish Chukani of Enam Holdings. And this is, of course, about the India-US trade deal troubles. Manish believes that there are two big powers in the world, US and China. Both want India firmly in their fold. India, of course, does not want to. And that is the right strategy in the long term, even though in the near term, it may cause pain.
Two countries like this can't be at loggerheads for long.
Yeah.
But the fact is we don't have too many things we can, hold someone to ransom for, unlike China. And therefore it's getting dragged on until like I said in the beginning, you're kind of now in a world of a G2 where there are two big bullies and you have to decide, you have to go in one camp. We don't want to go into either camp. And both of them are trying to, push us and prod us to fall into a camp. The better that we just stay out of these games that they're playing. And if it takes long, it's painful for the next 3 months, 6 months, 1 year, and for the companies and the individuals involved. But on a 10, 20-year cycle, I think what we're doing is the right thing, to stand with our position and what we need to do. So I'm not so concerned about how long it takes.
Well, Manish, also on what's happening with AI, the big spending which is going into AI, and what it means for India in the current situation. It's a tough situation, but Manish believes that in this tough phase, lots of important companies will emerge out of India, and he hopes that this is a wake-up call. Listen in.
I've said this for a long time, that you asked him earlier about, do terminal values get affected? Of course they do. It's like, would you now be buying Indian IT services companies at high multiples? You won't, because there is a terminal value to that business. For example, what happened to broadcasting TV versus OTT? You know that there's a multiple which is going to collapse. Any disruption, you know the losers very well. For example, if EVs take over, you know what will happen to ICE engines and so on. So that disruption is certainly damaging for a number of businesses. We don't know the winners as yet. And by losing out in this AI business, forget the valuations which may be bubble like today, but the business is real, like the internet was real. Now, my hope is that India is a beneficiary of the AI trade, because we use our data sets to find solutions which are unique to us. The way when the internet came, our types of businesses, financial services, for example, really benefited from it. We became a lot more global. We started having clients globally. Our research costs went down. So in the same vein, anyone with organized data sets, which is the next 2-3 year window of opportunity for our Indian companies to organize that. But what lies beyond that is how well we use this to get both efficiency as well as differentiation. So in that context, India is really falling behind in the technology space. But the way China took it as a wake-up call 10 years ago, when the first Trump presidency went hammer and tongs after them, and they realized that we need to stand up and create our own tech and our own markets and our own systems for doing things. I think that's a wake-up call we are going through today. The way it happened when we got hit with the first Pokhran explosions. And the next 2-3 years, actually, India woke up. I mean, the rise of what we did with ISRO and the defense industry really owes its origins to that period. I think this period will create a lot of important companies being born in India out of this need and this realization that we need to play our own game as well.
Well, on earnings, Manish says that 2026 is likely to be a tough year until earnings, come back into the mid-teens once again. He's bullish on what he's been bullish on for some time: financials, PSUs, hard assets, metals, etc. Listen in.
We spoke in Diwali, we spoke in December, so it's not changing because the calendar has changed.
Correct.
It is a tough year until earnings cross substantially double digits and come closer to mid-teens. People aren't going to come chase this market. Money has been going already to emerging markets from Korea all the way to Peru and Chile. The anti-US trade, in a way, has been on already. Metals have been doing well. Hard assets have been doing well. That trade continues. And I said even then that I would expect financials, hard assets, metals, and public sector, especially with the finance minister in the budget day now, a last big resource raising exercise is left is really from the PSUs. So these three would dominate this year in my sense. And if you make a double digit on the index, I'd be very, very happy. I would take it.
Okay, now to some views from veteran investor Ramdev Agarwal of Motilal Oswal Financial Services, who says that 2026 will be a better year as earnings cycle he believes is picking up for sure. He actually says that his universe of 350 companies is expected to grow earnings by some 20% in the third quarter. Autos, according to him, will be the star performer this year. Listen.
I think it will be better year because earnings cycle is turning for sure. Because I just saw the estimate from, we cover one of the largest number of companies here, 350 companies. So MO Universe, this quarter is expected to deliver 20% earnings growth. This is after 6 or 7 quarters, we are getting real upturn.
This third quarter,
earnings. Yeah.
20%.
Index itself could be about 8 to 10%, but all 350 companies put together will be about 20% aggregate. So let's see what comes out. And my sense is Q4 will be even better. I'm very kind of optimistic on the earnings cycle turning up after brief lull for last 4-5 quarters, and government is also after it. Now government is trying to put in place slow down in the credit cycle, slow down in the your credit cost. You are given fiscal benefit, you are given monetary benefit, you are given GST benefit. So government is firing all cylinders to get their nominal GDP growth going at 10-11% so they can collect taxes. They're not able to collect tax. You see the tax collection 2-3%, 4%. So they need to get to 12-14%. So now there is a vested interest of the government to reflect the economy to about 10-12% nominal. Hopefully with 4% inflation, it could be 7-8% kind of real GDP growth rate. That GDP growth is better than 7-8% now with nominal GDP growth of 8%, deflator being 0.5%. I think that doesn't fly in India. So I think we are again back to the old style, 7%, 7 plus 4 or something like that. So I'm optimistic that this will happen in next 12 months and which will push up the earnings cycle big time. As far as the sectors, I think large caps are better chance to beat the market than the mid and small. Second, I think PSUs still have a lot of steam. They are much more reasonably valued than private sector, and earnings growth is almost 2x of private sector. So that looks to be a very interesting category. And I think financials, I think auto will be the star of the year.
All right, get into a break. On the other side, the management of Keystone Realty will join in on the back of the company's Q3 business update. Welcome back. Markets absolutely flat, so it's a good time then to begin our corporate radar. Keystone Realtors reported a 13% increase in terms of the volume, areas sold in Q3, signaling strong volume growth. But in terms of value, the pre-sales dipped 3%. So there was a divergence seen in volume versus value. The company's 9-month performance remains robust, with areas sold higher by 43%. We have with us the chairman and managing director of the company, Mr. Baman Rustam Irani. Thank you very much for joining in. Sometimes we say that the market stock price is an indicator of demand. It's a leading indicator. They perhaps know more. And Realty has been a bit of an underperformer. And recently we heard about Signature Global, which is present in a different market, in the NCR market, but they highlighted demand concerns, the inability to meet the guidance that they had laid out earlier. So let's begin before we get into Q3 and Q4, etc. Is growth slowing down in any way in the Mumbai market, the areas that you operate in?
As much as I'd like to kind of answer that directly, let me just tell you that we are very much on path to achieve our 4,000 plus crores guidance. As a matter of fact, yes, quarter-on-quarter dip that you mentioned is not indicative of year-on-year growth. We are at 2676 crores of sales this year, which is roughly around 23% higher year-on-year. So we are well established in a beautiful city or in a beautiful area called MMR. I do not want to comment on the other markets, but what we can say about Rustamji is that we've chosen the right projects. We've been doing great amount of business development. We are an asset-light company. And my 4,000 crores, like I've said earlier also, I think that we will well surprise the markets by crossing this 4,000 crores by a huge margin this year. So I look forward to this last quarter of the year and announcing some great results. I also am very happy with the performance this year. I think I'll just quickly tell you, we've launched 5 projects, approximately 5,800 crores, which is about 83% of the guidance. And my business development, like I mentioned earlier, we've already crossed the 8,000 crore guidance in the first half year itself. So overall, we are on a good wicket. Mumbai MMR continues to hold its stead, and the markets are still very, very good.
Okay. And can you explain the divergence seen in Q3? Volumes up 3%, but value down. Sorry, volumes up 13%, value down 3%. What's changed in the portfolio to explain this?
It is like I mentioned, one should focus on overall performance, not on quarter. I really don't have a direct answer for you for that 3%, how the volumes go up, but that would just mean that we've been selling more of what is the government's Ladla, which is the affordable and mid-mass housing. You know, our project in Dombivli has done extremely well. Our Kasara projects have done extremely well. And it only means that launches of our new projects, which are in the upper markets or higher priced markets, will be coming in this quarter.
All right. Hi, Baman. Morning and good to see you. Ben, so you're telling us the demand is as strong as what you were expecting?
MMR has been and will continue to be, Nigel, I mentioned this earlier, in this 10-year run or 15-year run, we will see a few dips, which is always very good to remind all developers that nothing that goes up stays up forever. But at the same point of time, what I'd like to point out is Mumbai MMR continues to generate the greatest interest of all the markets that there are there in the country as of right now. By value and by volume, we've mentioned this before, that you have the highest sales. If you take Mumbai and Pune, it's almost 51% of the total sales of the country in terms of value of real estate, in terms of residential, recognized residential. So I see a strong run going ahead. We personally at Rustomjee are extremely happy to state that the walk-ins have been great. The number of sales that we've been doing have been great. The inquiries for our newer projects are great. So it just means that our policy of following the infrastructure wherever it is, and God bless this government, they've been giving us the best infrastructure growth this city has seen in the last, I would say, 70, 80 years. And very happy to be riding on this theory that this city will continue to grow, and we will be one of the proponents that will continue to have a greater footprint out here.
All right, Baman, is luxury doing well? Because there are signs that affordable housing is actually seeing a lot of pressure. Would that be a fair estimate?
You know, Nigel, affordable housing is a misnomer because the government calls it the 45 lakh rupee affordable housing. Whereas I'd like to state that anything under 1 crore, in the MMR, I mean, in Mumbai especially, and then in the MMR, anything under 75 lakhs is actually should be termed as affordable housing. You're aware that we do everything from 65, 70 lakh rupees, which is our Dombivli, our Kasara, and go all the way up to 150 plus crores, which is our Bandra sales. So we have the entire belt available. We do not see, I can state that again, we do not see a slowdown in any of these segments. But if you talk of purely affordable housing, there really is no project that I know of, and definitely not in my portfolio, which I can sell for under 45 lakhs today.
All right. And Baman, when you want something, it comes at a price. What about pricing? Do you think pricing is speaking out? I have a friend who has taken possession of one of the apartments that your company makes, and they were very pleased. However, pricing is something that, people are looking at very closely. Signs of weakness there or no signs at all?
I can tell you this, the Indian consumer, and especially the educated consumer, which is exactly the kind of people that we deal with, have always been value conscious and not really price conscious. So while, as you mentioned in your introduction itself, he is happy, and that is exactly what we look for. And if we were to just give lower prices, it would be with the help of the government, and the government has done this in the past. I can only state that premiums in Mumbai are extremely high, cost of construction is extremely high, the cost of doing business is huge. So Mumbai will continue to be, pricier than most of the other markets. I would love, and Nigel, you know this, I've said this in private conversations, I would love that, prices do not increase and volumes increase, because that is exactly what we are out to do. Increase the, volume of our sales, volume of our business, and then make our margins, at a steady state or a steady pace going forward.
All right, we'll leave the conversation here. Thank you very much for joining in. So Keystone Realtors saying that they're on track to beat their FY26 pre-sales guidance of 4,000 crore, even in terms of launch pipeline. Already in 9 months, they've achieved in excess of close to about 80,000. No signs of slowdown yet, at least in the MR region. The stock is down close to about 0.6%. We should pull up a one-year chart also of the stock. Dixon Tech is up 1.7%. We've got a gain coming through in Puravankara. That's the one reacting to the auto sales, to the numbers that came out for quarterly update. But let's move on now. ICICI Lombard is in focus on the back of the Q3 numbers. The net earned premium is up 12%, but the profit declined 9% on a year-on-year basis. To discuss the quarterly numbers, the outlook, we have with us Gopal Balchandran, CFO of the company. Thank you very much for joining in. The headline is that there is a rise of 12-13% in your premiums, but your net profit has declined. Can we talk about retail? Because retail has been the standout performer, very strong growth, but the losses have also widened. So what explains that? And what is on retail, what is the outlook going ahead?
Rima, good morning to you and to all your viewers in CNBC. Season's greetings first in terms of a good day to have this call. But having said that, let me kind of come back and put this in context. I think even in the past, I think what we have always maintained is to say that ICICI Lombard has always kind of stayed disciplined in terms of driving profitable growth. And hence, to that extent, is something that has got exhibited even for this particular quarter. And to your specific point on some of the retail lines that cuts across motor and health, you're absolutely right. I think what we are quite enthused is with some of the reforms that got played out towards the end of the last quarter that has clearly kind of increased consumer demand on ground, whether you talk motor or whether you talk health. On both of these lines, from an ICICI Lombard standpoint, let me take the health piece first. Retail health, our market share for quarter three, I think we are currently at about 4.5%. This number used to kind of largely hover around 3% levels in the previous years. Even on motor, I think in the first half, I think we didn't do as well. But if you were to see quarter three, I think we have been able to substantially narrow down the gap vis-a-vis the industry growth numbers. And in line with what I talked about even last quarter, for the month of December, we have had an outperformance vis-a-vis the market of almost about close to 400 basis points. So hence, very, very excited. And we continue to maintain market leadership in motor as a line of business. To your point on profits, on an absolute basis, this is exactly what gets reflected whenever you start seeing very strong growth momentum coming back. In line with the accounting prescriptions, the growth earnings gets played out over the next 12 months or thereabout. But the cost of acquisition that you incur for sourcing the business is something that gets expensed upfront. And that's the reason why more than the absolute amount of profit as what is to look at, it will be better to look at more a sustained return on equity, which we have spoken about for ICICI Lombard to deliver between 18 to 20%.
Yeah, and that'll be good. That'll be great. Mr. Balachandran, good morning. Good to see you on the program again. Prashant here. But sir, you mentioned market leadership and rising, strong growth. But is there got to be a balance between rising costs, losses, etc.? I mean, is it coming at the expense of profitability across? I mean, if you see underwriting losses, actually a loss in the motor segment, retail, and these are important, the most important segments for you, right? So is this leadership coming at a very significant cost in that sense? And how long can you sustain it?
Thanks, Prashant, for kind of asking that. And let me again then put this in context, which is what I was kind of referring to. So one is whenever you see high periods of growth, which is what we are quite excited with from an ICICI Lombard standpoint, as I said, the cost is expensed upfront. So for example, in quarter three, when ICICI Lombard has done very good growth, cutting across whether it's motor or health, my premiums gets earned over the next 12 months. Whereas my cost of acquisition that I incurred gets expensed out in this particular quarter in its entirety. That doesn't get deferred over the next 12-month period. So therefore, on an absolute basis, you will always see an outcome to that extent reflecting in terms of absolute underwriting losses showing an increase. But having said that, I think what we are equally mindful of is from an ICICI Lombard standpoint, that is something that you would have seen across quarters. We have always made sure that we kind of operate within the overall limit on expense of management that the regulator has laid down. And in the context of where we are on the profitability, let me again bring to light the industry numbers is something that we have for the half year in motor. Industry combined ratios for motor as we speak currently stands at 128% in the first half of the current year. ICICI Lombard's combined vis-a-vis that for the first half year was about 106.9%. So clearly we have had a huge delta vis-a-vis the market in terms of what we are underwriting at. And hence to that extent is where we stand in terms of our thought process of continuing to do prudent risk selection. And in the process, the point that I made, sustain an ROE in the range of 18 to 20%.
All right. Hi, sir. Morning and good to see you, Vin. Since you mentioned about combined ratio, tell us what's the trajectory from here on? What do you end this year with? FY27, what should we be looking at this number?
So, Nigel, we have spoken about even in the past. I think the endeavor will be always to try and, as I said, continue delivering better on combined. But again, this has to be looked in the context of, let's say, how the industry is kind of positioned at. While I put out the numbers to the earlier point that Prashant had asked, even the overall combined ratios for the industry as a whole for the half year, if you were to see, has kind of moved significantly north. from 113% to almost 119%. But from an ICICI Lombard standpoint, we continue to have that difference of more than 10% in the combined ratios that we have been kind of reflecting. So hence, to that extent, we will obviously continue to see how we can kind of do an improvement in our overall combined ratios. But more importantly, the earlier point that I made, to sustain that ROE of 18 to 20 that one would kind of look forward, whether it's Q4 or even for the matter of fact, as we head into the next year as well.
You've guided for a combined ratio of 102. Isn't that the medium-term goal? Do you get there in FY26 or does that get pushed forward to FY27 now, 102%?
Great question. So again, let me put this in context. I think as an industry, we have been going through various regulatory changes. We did have a change in the way the accounting prescription would happen for long-term policies. So hence, to that extent, that's the reason why even if you have looked at our investor script or for the matter of fact, investor presentation, we have called out numbers on both bases, which is the changed basis of 1 by n and also on an n basis. So if you were to stay focused on an n basis, because that is more reflective of the economic outcome of the book that one has underwritten, even for this Q3, if you would have seen, our combined ratios have actually improved. It was 102.3% in Q3 of last year. On an end basis, the combined ratio for ICICI Lombard in Q3 of this year has been 102.2%. And mind you, this is also a quarter where we also kind of took the full impact of the past service cost, resulting from, again, a very good reform in the context of labor code guidelines that got into existence. We had an impact of about 55 crores in the quarter. But to answer your point, I think directionally is what I kind of referred to. We would want to kind of see how we can continue to see our improvement in combined, but at the same time, try and continue to deliver a sustained ROE of 18 to 20%.
Mr. Balachandran, let me just go out of the third quarter syllabus for a bit, if you'll indulge me. We've been reporting extensively on over the last one and a half months about the fact that the government is very keen on insurance penetration. One of the things they feel is that insurance commissions paid out by insurers is too high. We put out a story yesterday that IRDAI is going to come out with a consultation paper on regulating commissions next month, this coming month. And what they're going to say is they're going to, it's going to contain proposals to cap commissions, lower commissions, and lower the overall EOM as well, the overall limit as well. So I just wanted to understand, because you mentioned that thing, right? I mean, premium is collected over a period, costs are expensed immediately. There was this one proposal where insurance companies had sent to IRDAI, or at least that was discussed, that deferring commission payouts instead of upfront do it over a period of time, and based on if the policy has to be continued for those payouts to happen, so it becomes dependent on that. Are these big changes? Will this make a lot of difference to insurance companies? I mean, how significant will some of these things be? I mean, I know this is what we reported, so I'm just asking you to respond to what we've reported. So just your view to that.
So again, Prashant, I think I'll just put this in context. I think one has to look at this in line with, let's say, what the IRDAI had done about a couple of years back. I think rightfully so, what they did was to kind of start getting every company to operate within a defined overall limit on expense of management, which is what I refer to as a company which is into multiple line of businesses. They have to run their overall costs at less than 30%. And ICICI Lombard as a company, I think we go back to any number of periods. I think we have always kind of made sure that we operated within the threshold. I think the key thing in line with, let's say, the thought process of where the regulators / various authorities are getting into is to make sure that the overall cost of insurance becomes affordable for the general
consumer. That my question is pointed. If commissions are lower and EOM itself is brought lower, will that make is that very meaningful as a change? And we understand the aim is to implement these from the 1st of April.
So, which is the point I was referring to, Prashant. I think directionally, these limits of expense of management is very, very positive. And the key will be to make sure that as a sector, we continue to kind of operate at levels which are lower on an aggregate basis. And that hence to that extent, I think we will be very, very, of course, we will kind of welcome any final report that gets kind of put out. But any guidelines which kind of says that insurance sector as a whole has to run within an overall expense of management limit within a threshold, we will definitely welcome that change.
Okay, you're not giving out much, but I'm sure you're noting our reportage, and maybe it is a big discussion point in the industry as we understand it. Thank you very much for joining us. We'll see what happens, and we'll request you to come back once we have that consultation paper. Then maybe we can, talk some specifics, etc.
More specifics around that. Yeah, absolutely.
Thank you, Mr. Balasundran. All right, I think later today we have Infosys, which will be reporting third quarter numbers. So HCL Tech, TCS, now Infosys. What should we expect, Rima?
Well, expect a muted quarter, operationally at least. On the bottom line, the numbers that we have do not adjust for the new labor code and the provision that the company will take. So profits, as we've seen in the case of HCL Tech, TCS, Tata Elxsi, are likely to decline on account of that. But here are the numbers X of that. Revenue growth is seen flat on a sequential basis in Q3. This comes on the back of a 2.5% improvement seen in Q3 and Q4. In Q1 and Q2. But considering that the company gives you a guidance, you sort of have an indication of what they expect in Q3 and Q4. Margins are seen up 21.3%. Profits on an adjusted basis are also seen up nearly 1%. Now, the company had won a very large NHS order from UK, 1.2 billion euros. According to CLSA, some impact of that will flow through in Q4, but full quarter visibility of this deal win will happen only in Q4. In terms of the guidance, the full year guidance stands at 2 to 3%. The company is likely to narrow it. So usually when they start the year, more the uncertainty, broader the guidance. If it's a very uncertain year, they would give a 2 percentage point gap between the lower end and upper end. They started, current guidance stands at 2 to 3%, but now after Q3 numbers, there's only one quarter. So usually what the companies do is they narrow it. So 2.5 to 3% is what analysts expect. Margin guidance likely to remain unchanged at 20 to 22%. What will we watch? Well, last time the company said the retail is the weakest link. So, what is the update on that particular segment? Will the company also consider start sharing AI revenues details like HCL Tech does and TCS does? Clarity on technology spending for the upcoming calendar year, if there is any impact of the increase in the H-1B visa fee and the weighted selection process, which will be starting on the 27th of February. And then, of course, AI adoption and its impact on margin and pricing. But all in all, expect a steady sort of a number this time around. Vinay Rajani of HDFC Securities is now joining in for a quick technical check on the market. Vinay, quiet so far. What is the trade that you're recommending?
Yeah, good morning and thanks for having me on the show. So yes, market is trying to sustain at lower level and sustain at higher levels. And the day before yesterday's recovery was quite significant. Monday's low was around 25,473. That has become a strong support now. And it seems that market is into a consolidation phase while some sectors are really outperforming, like metals have been performing well. So after precious metal, we can see industrial metals and base metals have started performing well. So sector specific, there is bullishness. Some PSU banks are really doing good. So that is going good. Now oil related stocks are doing good. So stock specific, sector specific, we are bullish on the market. On the upside, we see a strong resistance around 25,900, which happens to be the 50 days EMA for the Nifty. So we can say that we are in the consolidation between 25,500 to 25,900. So that's where we have to play, and sector specific, we have to take bullish bets. So these are the support and resistance. Once we take out the 50 days EMA, then there is a good chance of bullish momentum getting back into the Nifty. But till then, we can say that it is into overall consolidation.
Okay. In terms of specific trades, Vinay, what would you recommend?
Yeah, so as I said, the metal sector has been performing very well. Our previous recommendation was into Hindustan Copper, and that played out very well. And now we feel that the steel stocks can participate from here because we see some long-term chart breakout coming in the HRC, Chinese HRC, as well as the iron ore charts in the commodity markets. And that is ultimately positive sign for the steel stocks also. And we can see that strength building in the steel stocks from here. So Tata Steel is one of the stocks which we like for the short term. Around 185, one can go long. I would suggest a stop loss at 181. On the upside, my immediate target should be 192. The second stock I would pick from the oil space related to crude. See, Chennai Petro is looking strong on the chart. So MRPL and Chennai Petro both have been moving up. So Oil India was my recommendation, but that has already moved up. So better to look at the stocks which are beneficiaries of this particular theme. So Chennai Petro in the cash segment looks good around 840 odd levels. One can go long. 820 should be the stop loss. On the upside, I'm expecting a target of 870.
Thank you, Vinay, for joining in. Get into a break. On the other side, Manisha Gupta will join in and talk commodities. So stay tuned.
Okay, welcome back. We'll shift focus to the commodity markets. Manisha is here with the top commodity on her mind. I mean, forget stocks. It's silver, it's copper and whatnot. Manisha, take it away.
I have a list of top commodities, by the way, because there's so much movement here and so many of them making those all-time highs yet again. But I do want to start with silver because we're almost nudging that $90 an ounce mark. The COMEX futures in silver have already hit 90 and beyond. But we are looking at spot markets. Oh, okay. This is what you have. This is in 10 minutes, $91 an ounce on your screen. So this is an all-time highs yet again for the silver prices. We're trading 5% on the higher side right now. And silver is a space where you are looking at very strong fundamentals, strong speculative money coming in, lack of sellers, and then it also has been about, even with CME margin hikes, it really has led to those dips being bought into. In addition to that, you have China restricting exports from the 1st of January. Only 44 companies can export now, and China exports nearly 70 to 80% of global refined silver. So that is where the concern comes in from. And because of that, the silver lease rates are now standing at around 8% on a 1-month equivalent. So if you want to borrow silver for 1 month, you have to pay 8% on this amount there. Mexico, which is the largest producer of silver, has been looking at lower volumes and declining ore grades as well, in sense supporting silver prices therein. It also has to do with the very strong inflows of speculative money, as I said. That seems to be keeping the silver prices higher. There are only buyers and no sellers, and is the reason you're looking at an all-time high of 91 on your screens. 90 has been taken and quite easily in the Asian markets right now. Take a look at the gold prices. This is an all-time high yet again for gold prices. Support coming in from China buying gold for a 14th straight month for the month of December. Now, with the kind of buying that China has done in December, the total quantum in sense of Chinese holdings in sense of gold stands at 74.15 million ounces there. Gold also is looking at very strong ETF buying, physical buying. When you look at the ETF numbers in the global markets therein, it's a record high holding at $89 billion. If you look at that in quantum terms, well, that comes to almost 1,073 tons, which also is a 3-year highs. The central bank buying in last 3 years has been to the tune of 1,000 tons plus this year as well. You could be looking at numbers of 800 to 1,000 tons therein. And then this is the 3-month forecast that has come in from Citi overnight, which says that gold prices could be hitting $5,000 an ounce between now to 3 months. And silver, $100 an ounce seems to be a number that has come in from various banks who continue to reiterate higher follow-up revisions in sense of silver prices there. And then it is also about what is supporting precious metal prices. Well, the U.S. inflation data lowest since 2021 signals rate cut possibility. It also has to do with the Department of Justice inquiry tied to Fed Chair Jerome Powell. Autonomy of U.S. Fed is something that has been a concerning factor there. U.S. announcing 25% tariff on countries trading with Iran. It also has to do with U.S. saying that they could intervene in the unrest in Iran. U.S. also has the seizure of Venezuela's Maduro in a military raid. The U.S. also is threatened to take control of Greenland. So half of the things really seem to be coming in from U.S. right now, which are supporting tangible commodities therein. It also is about attacks on 2 oil tankers near Caspian Pipe Consortium's Black Sea terminal, adding premium to prices there. I want to bring on screen on what we have done in this year until now for many of those commodities. And there you have it, clearly outperforming various other asset classes. So gold in last year gained up by 65%. It's already up 7% right now and trading at all-time highs. Silver prices 147% last year, 26% higher this year, trading at an all-time highs. Copper 42% last year, 7% up this year, trading at an all-time highs. Platinum, 125% of gains last year, 18% this year. We're trading at multi-year highs onto this one. And aluminum, after those 18% gains in last year, with 6.5% of gains, is trading at a 3-year highs. Tin as well, 18.5% of gains is trading at a 3-year highs. Zinc is trading at a 1-year highs. You have palladium prices trading very close to its 11-year highs with 17% of gains. And you have crude prices, 3 years of decline, but this year is 7% higher. So everything that you want to touch in commodities is trading at multi-year highs.
Absolutely. It's new. It's basically a completely crazy cycle we're seeing in some of these commodities, especially precious metals, but no less copper. By the way, some estimates say that copper is just as an asset class, is seen for the most absolute highest amount of price return in 2026 compared to everything else. So that kind of tells you the mood with some of these commodities. Manisha, thank you very much for that. Time for a quick commercial break here. Lata will connect with the management of Bank of Maharashtra, and she breaks down their third quarter earnings. So that's coming up in just a bit. Stay tuned.
Welcome to Earnings Central. Bank of Maharashtra rang in the banking results for the quarter with an outstanding set. Advances have grown nearly 20%. Net interest margins appear to have bottomed. They've risen slightly to 3.86%. And NPAs have fallen as they have been for the last several quarters. What's best? The bank's return on equity is probably the best in the sector at 23.8%. Joining me now is Mr. Nidhu Saxena, Managing Director and CEO of Bank of Maharashtra. Mr. Saxena, good morning. Happy Makar Sankranti to you and to all our viewers. You know, if you produce results like this, it becomes very difficult for a journalist to ask tough questions. But I'm going to begin with one issue that seems to stare. You know, your advances are growing far faster than your deposits. So loan deposit ratio has risen to 85. Is this a problem? I mean, how do you propose to tackle it?
Good morning and happy Makar Sankranti to you, to Lata, and all the viewers. Yes, LDR in my case has gone up to 85, rightly noted, but this is the global CD ratio. What has happened during this FY, we have started our IBU operations. In September 2025, we had 100 million. In December 2025, we have reached to 400 million, which is around 3,500 crores. So if you exclude this, the domestic CD ratio is 83%.
Okay.
And what we have done is, Lata, what lot of bulk deposits, high-cost bulk deposits were allowed to leave the system, and we have relied on other alternate sources of raising resources. So we went, today my refinance outstanding is almost 17,900 crores. So if I exclude this, my CD ratio is standing at 78%. And I still have room to grow, because what we intend to do is to maintain our CD levels around 82, 83, where we think we have effective deployment of our resources and the maximization of the interest earning opportunity.
Okay. No, fair enough. I mean, there are banks with even 100 LDR, so you won't count as an outlier at all. But how do you see yourself tackling this? What kind of a guidance can you give us for advances? Will they continue at 20%? And therefore, what will deposits be?
If you recall the guidance for FY 25-26 that we shared in the beginning of the year, advances would be growing at 17%,
yes,
what we said. But what is actually we are experiencing, like this gift IBU, over and above this, we are opening under a project we are calling Project 321. We are opening 321 branches in the period of 18 months. While I speak today, we have already made 116 branches functional in this FY. Now, let's appreciate that these branches, whatever business they are doing, base for them is zero. So whatever incrementally they are giving us, it is over and above the last year number is zero for them. So that's how I think, and this new branch expansion drive is going to continue for some time, and this will actually sustain the high double-digit growth both in the asset side and the liability side.
Okay. So you mean your deposits, deposits you had guided at 14%, you will do far better, you're saying?
Yes. So if you see this December quarter, advances have, deposits have grown YOY 15%, within which the low-cost CASA has grown YOY 16%.
Yeah.
So our, if you see September 2025, our total deposits grew by 12%, within which the CASA grew by 15%.
Okay.
So focus is clearly on the low-cost component. The high-cost bulk deposit, it is just a matter of function of interest rates. Today, I can easily decide to tweak my interest rates, and a lot of deposit will flow to the system. But we will grow our deposit book very mindfully, looking at how it is going to impact the bottom line.
Fair point.
We have other sources, refinance, infra bond raising. We will keep exploring these options to see that profitability, the business that is growing is a profitable one.
Okay, it's good to hear that you all are so mindful of all these other ways of raising money. Mr. Saxena, which brings me directly to margins, since you're speaking about cost of funds. You all have actually improved from the previous quarter, from 3.85 to 3.86. This is despite one more rate cut coming. So can we say that 3.85 was your bottom and now you're only going to see margins improve? Any guidance?
So when the rate cut cycle started in Feb 2025, we were mindful and looking at the numbers and calculations. Our calculation and the portfolio, which is linked to repo, was giving us a sense that around 18 to 19 bips contraction will happen in the NIM.
Yeah.
And by the third quarter, we were expecting, and most of our deposits had repriced with that. So we were feeling that there should not be any further contraction in NIM. And if all goes well, we should see probably some improvement. So 2 bips improvement has come in NIM. But I would like to maintain guidance number of 3.75, which we shared in the beginning of the year. Because there could be a rate cut further, and that will impact me along with other players in the system. But let's not forget that 3.75 also is a decent number, and I think we will like to maintain that number and achieve it also.
My sense is you are, playing very conservative and overachieving. I hope you won't give me the same answer for the ROA. Your return on assets, you had guided 1.75. You're already at 1.86. So can you guide us when we hit 2? This is a very good performance.
So, Lata, this is a journey which quarter on quarter we are trying to look at these ratios. What are the factors that contribute the numerator, the denominator? I only can say that we are mindful of these ratios. We should give the comfort to the markets that if they have reposed faith in the bank equity, they are getting the right positioning at right levels. So the point is, I will continue to maintain my guidance. Maybe conservative, yes, 1.75. But yes, I think the way we are growing, sooner or later, we may like to give a fresh set of numbers of guidance where ROA can be enhanced from what 1.75 that I have maintained for this year and even the last year.
Okay. Well, I guess it's important that you're playing very conservative. Let me come to your gold loans. Actually, all retail loans, 36%. I wanted to ask you if you can maintain this kind of a pace. But before I come to that, specifically gold loan risen by, it's almost doubled. What is the kind of LTV you are maintaining? Because a lot of analysts worry that if gold prices fall a bit, are you all still safe?
So if you ask me around 18, 20 months back, the gold portfolio we were having was around 7,500 to 8,000 crores. Today, along with co-lending, we have reached 22,000 crores. Minus co-lending, my gold loan that has happened through branches is around 17, 18,000 crores, and which is translating to that between 45 to 50% year-on-year growth quarter on quarter. So this gold loan LTV, we are going as per the Reserve Bank of India guidelines. And we are also very mindful, conservative. We have, in fact, designed our products where my LTV is low. We are giving a price concession to the consumers. So they can pledge a gold, and if the loan requirement is lower, we will price that product at a competitive lower price. So that's how we are also mindful that if what if the gold prices should come down, how it will impact my portfolio. We have a robust mechanism when we have increased this portfolio, robust mechanism to see that even at the account level, if there is any breach from the LTV on an ongoing basis. So we follow that very meticulously. And I think we are the kind of benefit gold loan as a product is giving. It comes with a zero risk weight. there is still a huge scope for banks to grow, is what I sense.
Okay.
And we are keeping this as a focus product. The only two things that we make sure before we allow even a branch to start doing gold loans is the purity check of the gold loan and safekeeping of the pledge tournaments.
Okay.
Once
Well,
those two things are done, we go ahead and permit the branches to do gold loans.
I'm sorry I'm interrupting you, sir, because I'm trying to pack in probably half an hour of questions in the 10, 12 minutes given to me. But this one I have to ask you, because you're the first bank announcing numbers. Was there any impact of the labor codes?
So, while we are mindful, the code has come, some rules are under framing, but whatever has come, we have looked at those. Impact in our case, because my contractual staff strength is minimal. So we are not seeing any significant number to even share here. It's a very minuscule number that is coming as an impact of labor code. And I think we will keep, if more rules are coming, we are watching those. But to give you an answer, no major impact, no significant impact at all on Bank of Maharashtra on account of the new labor. And the reason is that my contractual versus the permanent payroll staff, it is minimal.
Okay. No, I get your point. Actually, the IT companies kind of put us on watch. Otherwise, we were not even preparing for this. Suddenly, the investor community is becoming aware that this can impact. It's good to hear that the first bank that's reporting numbers is saying that it's going to be a minuscule impact, as of now at least. A very quick last question, sir. You know, recoveries. Last year, you did 1375 crores. This year, you have already done 1044. Where do you end the year, you think? 1500?
So this is, I think, the number you have shared is recovery from the written-off book.
Yes.
So what we are having a stock of almost 21,000 crores. And the last 2 years, we have, in a very focused manner, looked at recovering from the TWO book. And we have kept, because around out of 20,000 crores, around 8,500 crores are in NCLT at various stages. So at times you may not be very sure when the resolution will come and in which quarter. It may go to the next quarter while we expect this quarter. So we have kept a number of 1,200 crores to 1,500 crores annually to be recovering from TWO book for the next 4 to 5 years. And that number, once we have done, we have kept 2 special schemes where we are giving a NDND kind of a feature, non-discriminatory, non-discretionary, and we are able to resolve a lot of loan assets in the TWO up to 50 crores under these 2 schemes. And we have seen that strategy is working well. Last year, we did 1375, but I have kept a number of 1,200 to 1,500 crores annually as recovery number from TWO book for the next 4 to 5 years. So today we have almost reached 1,200 crores, and I think the last year was a success year. This year also we will be ending the year between 1,200 to 1,500.
Okay, so I've overshot my time, but I still have questions. Let me take a rain check for another day to ask those remaining questions. Thank you very much, Mr. Saxena, for spending time with us, and congratulations on ringing in the banking results with an outstanding set of numbers. Have to wrap up on Bazaar on that note. Chartbusters up next.